Hi guys, welcome to another revision session. Anna. This is about Ind AS 36 obviously. Now with respect to the power nodes that I've used in this particular in this particular session, either you'll find it you just need to go to the website caprasannakumar.com. Okay, I'll try to put the link in the description or in the comments. In that you'll have something called free downloads. From that you can download this material. In case if there is an emergency and if you're not getting it, then I'll put it in my Telegram channel. That link also I'll put it. The Telegram channel name is PK Sir Classes. PK Sir Classes without any gap. PK Sir Classes. That's all. In the Telegram channel also you can find this revision material. Either there or here it will be there. Whatever it is, I'll try to put it in the comment section, because sometimes what happens, the moment I upload this video in the YouTube, sometimes in the website the material may not be available. But if it is like 1 or 2 days, then definitely it will be available in the website. Otherwise, you can also find it in Telegram. The Telegram channel name is PK Sir Classes. I'll try to put the link in the comment section. Another thing is, we put a lot of efforts behind these videos. I want you guys to comment what you feel after watching this video, in what way it has helped you in your preparation process for the upcoming exams. Okay. And if there is anything also, like for example, any specific Ind AS that you want me to take, some are asking for 101. Many people have asked me for 103 and 110. Anyway, I'm going to come up with that. Next video is going to be on 101 and 103 and 110. But if there is anything other than that as well, you have to comment, Nana. The more number of people if you comment. So why I'm asking you to comment is because hardly it will take a second. But if I can understand what you guys are thinking, then only I can accordingly, do the work and make a video, right? So hardly it takes a second for you. So whatever you feel, you try to communicate in the way of comments. So I'll see that, I'll understand that, okay, majority of the students are wanting for this. Then I'll know what you guys know. Because otherwise I have to go with imagination, Anana. So it won't work for either of us. So you please comment if you really love the video, like it, so that it's like a motivation for us for all the hard work that we are doing for late lights and all that. And if you comment, then I'll know what I have to do next. So I told you I'll be doing this journey till your examination. So it helps us, right? Anyways, hope you guys enjoy this video, and hope this video helps in your examination process. Cheers, guys. All right. Hi, Nana. So let's start with Ind AS 36. Okay. So now let's start with Ind AS 36. I can't say whether this is a difficult Ind AS or easy Ind AS. It's somewhere in between. Most of the times the concept feels not so difficult to understand, but there are certain areas, especially in case of CGU, where it is a little bit difficult to understand, but that's okay. Anyways, we'll cover all the concepts. Okay. Now let's start with the first question. Impairment means what? What is impairment? To put it very simple, reduction in the value of the asset. If the asset value gets reduced, we call it as impairment. All right. Not exactly decline in the value of the asset. It is decline in the value of the asset when compared to the carrying amount. Sir, what is that, sir? We'll try to understand. Just a basic idea I'm giving you right now. The first question that we need to ask ourselves is, why Ind AS 36 is considered complex? Why people are not that comfortable with impairment? The reason is, most students, they are comfortable with depreciation. With depreciation, what do you do basically? You reduce an asset's value systematically over a period of time, right? Whether it is straight line method or WDV method, either way, right? But what happens when an asset's real world value drops sharply? So this is the keyword. Already you're doing depreciation. Through depreciation, asset ka value is reducing because you're using the asset naturally, correct? But sometimes what happens, beyond the depreciation, the value of the asset will drop more than depreciation, below even its depreciated book value. Depreciated book value is nothing but carrying amount. Depreciated book value is nothing but carrying amount. Okay. So this is where Ind AS 36 comes into picture. So first I'm trying to give you a background. Why there is a need of Ind AS 36. It introduces the concept of impairment, a mandatory check to ensure your balance sheet never shows an asset at more than what it can actually recover. For example, we'll be seeing those examples as well. Like right now, just get an idea, get a feel of it. So which means already you're doing depreciation. With that, asset value is dropping. You're reducing the asset value. But beyond that, if it drops, because of whatever the reasons it can be, advancement in technology, there can be some disruption in the economy, whatever the reason it can be. So your asset value drops beyond your depreciation, which means after depreciating, you'll have a book value, which is nothing but carrying amount. your asset value drops below that carrying amount, then that extra drop in value, we call it as impairment. Extra drop in value of the asset due to external or internal factors, as the case may be, is called impairment. Okay, I'll write like this: extra drop in value of the asset beyond depreciation. So what do you mean by depreciation? Depreciation is nothing but usual drop in the value of the asset. Correct? I hope this is clear. Right. Okay. So that's the basic idea of Ind AS 36. Fine. But what is the problem in Ind AS 36? Why it is considered as complex by few students? Very simple. One is they get confused when they are calculating something called recoverable amount. Sir, what is that, sir? We will learn. We will learn. But just get a feel of it. Now you need not remember anything. Just get the feel of the standard. There is something called recoverable amount. Okay. There is something called value in use. Okay. There is something called cash generating unit that you'll get in this particular Ind AS. Okay. There is a special treatment for goodwill as well as corporate assets. Sir, what is corporate assets, sir? You will understand. The rules are on reversal of impairment. Sir, impairment can be reversed also, sir? Yes, sir. For that also there are certain rules. So we'll be covering all these topics. Once we cover all these topics, this particular Ind AS is done. So that's all, sir. These are all the things that we need to learn? Yes. Which means we're going to learn how to calculate recoverable amount. We're going to learn how to calculate value in use. We're going to learn what do you mean by cash generating unit. We're going to learn what is the special treatment for goodwill as well as corporate assets. We also going to learn how to reverse what? Impairment. Once we are done with all these things, this Ind AS 36 is pretty much done. Okay, fantastic. Right. Are we done? Okay. After that, with the help of this particular example, let's try to understand. Now we are going to understand how to calculate impairment. Ready? Okay, we'll do one thing, Nana. Before we go with this, first let's go to the scope. Scope means what is covered under Ind AS 36, what is not covered under Ind AS 36. That's better. We'll get clarity first, and then we'll go for what? How to calculate impairment and all that. Look at the scope of Ind AS 36, Nana. Ind AS 16 is covered. Correct? What is Ind AS 16? PP. Now the question is, okay, I know that Ind AS 16 is covered. Okay, 38 is covered, which is intangible assets. 40 is covered, which is investment property. Okay. Goodwill acquired in business combination, 103 is covered. Financial assets classified as investments in subsidiaries, associates, and joint venture. That is Ind AS 110, 28, and 111 is also covered. Okay. So this is pretty easy to remember. Now the question is why they are covered. Why they are covered? Let's start with Ind AS 16. What kind of assets are covered under Ind AS 16? Sir, PP, sir. PP means what? Long-term productive assets. Correct? These points are very important. I'm giving you logic. Long-term productive assets. Correct. Whose value can change due to technological changes, due to market disruption. You understand the point? So therefore, impairment testing is important for those assets. So your normal depreciation will not affect the value of the asset. Sometimes technological changes also will affect the value of the asset because these assets are very long term, 5 years, 10 years. So a lot of things can happen. Therefore, it has to be tested for impairment. That's why it is covered under Ind AS 36. Clear? Next, 38. This is nothing but intangible assets, which includes patents, trademarks, and all those things. Software also, for example. Okay. Now, why this is covered? The answer is very simple, especially when there are intangible assets with indefinite life. Sir, it is 20 years, sir, 25 years, sir. Then it has to be covered, Nana, because I need to test it for sure for impairment so that I'm not overvaluing the asset. Okay. Next, 40. What about 40? You are holding these properties for capital appreciation only, na? Either capital appreciation or rent. Then only it is covered under 40. Correct. When you do that, there is a chance of those properties getting affected by market value changes. Correct? Because market value can decline. Real estate property value can decline, Anana. You understand the point? So therefore, impairment testing is required. Okay. What about goodwill acquired in business combination? Anyway, you are not amortizing, na? Goodwill acquired in business combination as per Ind AS 103 is not amortized, never amortized. Then how can I check its value? Is it being shown at the correct value or not? I have to do impairment testing. because anyway I'm not doing amortization. Got the point? Right. Okay. What about this one? Financial assets classified as investment in subsidiaries, associates, joint venture. This is nothing but equity investments, na? This is nothing but equity investments. Obviously, equity investment will be subject to fluctuation in value, na. So therefore, this also has to be tested for impairment. Financial assets classified as investments in subsidiaries, associates, as well as joint venture. Here, okay, sir. Sir, it's easy only, sir. Remember, equity investments, okay, for subsidiaries, joint venture, okay, then associates as well. What else? 16, 38, 40. Okay, what else? 103 goodwill business combination. That's all. Easy to remember. Okay, sir. So this is under scope, which is covered under Ind AS 36. Okay, what is not covered? What is not in scope? Let's have a look at this because this is very important. This is common exam trap. Why? Because what is not covered, people tend to get confused. I'm telling you, this is very, very, very important. I've seen students getting confused with respect to this area only. So focus carefully. Trade receivables, the debtors, sir, yes. Inventory, sir, it is covered under Ind AS 2, yes. Investments other than subsidiaries, associates, and joint ventures. Equity investments with respect to subsidiaries, associates, joint venture is covered. Other than that, equity investments will be there, na? That is not covered. These are excluded from the scope of Ind AS 36. So the following assets are not tested under Ind AS 36. They have their own impairment or write-down rules. That is the reason it is not covered. If somebody asks you why inventory is not covered, because they have their own impairment or write-down rules, Nana, as per Ind AS 2. Then why should I get it covered under Ind AS 36? Anyway, it is already covered now. You understand what I'm trying to say? So even trade receivables also same logic. So therefore, these things, they have their own impairment or write-down rules. Therefore, there is no need for it to be covered under Ind AS 36. Simple logic. Okay. This is the reason why they are not covered. Then why they are not covered. I hope this is clear. Right. So what are these? First one, inventories. Why they are not covered? Because they are governed by Ind AS 2, where cost or NRV, whichever is less, will be the value. That's where when obviously your cost is less when compared to NRV, you are writing down the value, na? So you're already testing it for impairment. That's anyway happening every year at the end of the year. So we are done with Ind AS 2. So you guys should know that. Financial assets, trade receivables, loans or bonds governed by Ind AS 109. Expected credit loss model is there, na? Where we are already doing it. I don't know whether you can recollect financial instruments or not, but we have done so many problems based on this. Trade receivables, loans as well as bond, which is governed by Ind AS 109, especially expected credit loss model, ECL. ECL. Okay. Deferred tax assets governed by Ind AS 12. Separate recoverability assessment applies. That we have seen already in Ind AS 12. Okay. Employee benefit assets. We have covered it under Ind AS 19. Investment property at fair value. Sir, what is investment property at fair value? It is not covered. See, understand one thing. Investment property is covered under Ind AS 36 when it is measured at cost. When it is measured at fair value, then it is not covered. Logically speaking, in our so-called Indian AS, that is Ind AS, which is 40, investments will not be measured at will not be measured at fair value. It will be measured at cost only. But in international IFRS, international accounting standards, it is measured at fair value. Are you able to understand? So logically speaking, this is not a fair point because as far as Ind AS 40 is concerned, you measure your investments, investment property at cost only, but you will disclose its fair value. You will measure it at cost only, but you will disclose its fair value. Clear? But in international accounting standards, what happens is that you can also measure it at fair value. Clear? So therefore, this point, don't focus too much, but these are all the reasons why these are excluded. Okay. Now, let's come back here. So, till here, what did you understand? Sir, what is covered, what is not covered under Ind AS 36? I've understood, sir. What is in scope, what is not, what is out of scope? What is in scope, sir? Very easy to remember, sir. 16, 38, 40, 103 goodwill business combination. Okay. Then we have investments, equity investments, sir, in subsidiary, associates, as well as joint venture. Simple. Okay. What is not covered? Sir, predominantly inventories is not covered because Ind AS 2. Then trade receivables, all those things, Ind AS 109, ECL method, that is also not covered. Then we have this so-called, what is that? deferred tax assets, and then employee benefit assets, because one is covered under Ind AS 19, one is covered under Ind AS 12. All these things are not covered. Apart from that, investment property at fair value, anyway, we are not doing it. We are only disclosing it as per Ind AS 40. Therefore, typically, that is not a valid point, because basically what happens in international accounting standards, you can also measure your property at fair value. That is not allowed in India. Okay, chalo. Done. The scope, out of scope we have seen. Now let's go for case 1. This is the first example. With this example, let's try to understand how to calculate impairment. How to calculate impairment. Ready? Now look at this example, Anna. With this example, basically you'll understand the entire impairment calculation. Okay, so I've made it very simple. So let's go through this story. Okay, if you can see this case 1, on 1st April 25, let's say the cost of the asset is 60 lakhs and the life of the asset is 6 years. So let's say we apply straight line method and there is no residual value, say for example, at the end of the life of the asset. In that case, the depreciation will be how much, Nana? 60 divided by 6, which will be 10 lakhs. Okay. 1 year ho gaya. So if 1 year is done, just a second, Nana. Alright, Nana, small technical issue. Never mind. Now, so look at this. After 1 year, your machine value is how much? 60. And for 1 year, the depreciation will be how much? 10 lakhs. So the carrying amount will be how much, Nana? 15. Okay. Then for another year, the depreciation will be 10 plus 10. 2 years, na? 20 obviously. Carrying amount will be 40. Okay. So now let's say in the second year, at the end of the second year, there is something called a triggering event. Sir, what do you mean by triggering event? We call it as indications of impairment. So which means impairment just like that will not do. Okay. Something needs to trigger impairment. Something needs to happen either within the company or outside the company. We call it as external indicators outside the company, internal indicators within the company. So which means something needs to happen. A technological change or some sort of technological disruption, something like that, market disruption or something like that needs to happen. We'll discuss all those reasons. Okay. Once that, we call it as a triggering event. Once something like that happens, then you get a doubt that I have a doubt with respect to my carrying amount of my so-called asset, whether it can recover that sort of value from the market or not. Which means if you look at the depreciation over here, already I'm reducing the value of the asset all the way from 60. Now it has become what? 40. That I'm already doing. But impairment is beyond the normal reduction in the value through depreciation. That's what we have seen here also, na? Extra drop in value of the asset beyond depreciation. So therefore, I have a doubt. When do I get a doubt? Because of an indicator. What indicator? External or internal, which can also be referred as triggering event, which will attract Ind AS 36. Once it is attracted, once there is an indication of impairment, what is that? We'll discuss later. Once there is an indication of impairment, then only we will go for impairment testing. Now the next question is, okay sir, how to do impairment testing? Very simple. We will compute something called recoverable amount. Okay. Sir, what is recoverable amount? It is the higher of the two. What is higher of the two? Value in use or FELCTS. Fair value less cost to sell. Okay. Sir, FELCTS is very easy to find out. You'll find out the fair value in the market, less cost to sell. So this will be ready-made information available in the question. Value in use, what is this, sir? Well, the logic is very simple, Nana. To calculate the impairment loss, we need to compare the carrying amount, in this case 40 lakhs, with recoverable amount. How to calculate recoverable amount? Value in use or FELCTS, whichever is high. Now, why you are considering two things and you are saying whichever is high? Because when I buy an asset, I can recover my investment in the asset either by using the asset or by selling the asset. Correct? I have two choices. Nana, if I buy a car, Nana, for example, I can recover, let's say 20 lakhs I've invested to buy a car, okay, for my company. How do I recover the 20 lakhs what I've invested for the car? Either by using the car for daily transportation or whatever it is, or I can also sell the car later, na? So either by using the asset or by selling the asset, in both the cases you can recover its value. So I need to consider both the options. Value in use is nothing but the option that you are trying to consider by using the asset, how much value you can recover. FELCTS is nothing but the option where you are considering, if I sell it, how much value can I recover? Whichever is higher, I'll go for that option only, Nana. Very simple. That's what optimistic point of view, right? Simple. So therefore, first, there must be a triggering event which will trigger the impairment testing. Once it triggers, after that, you need to calculate recoverable amount, which will be compared with carrying amount. How to calculate recoverable amount? Either value in use or FELCTS, whichever is higher. FELCTS, nothing much to discuss. It will be given in the question only. Very easy. Value in use, how to calculate? That let's figure out. Value in use is nothing but present value of future cash flows. What is VIU? Present value of future cash flows. Okay. How to do that? I just gave you an example over here. Let's say life of the asset is 4 years, Nana, for example. By using that particular asset, you can generate cash flows of 6 lakhs in the first year, 4 lakhs in the second year, 4 lakhs in the third year, 4 lakhs plus salvage value, if any, in the fourth year. Okay. You need to discount it. Let's say discount rate is 10%. Then you will be getting present value of cash flows or discounted cash flows. Total it up, which comes around 14,49,400. This 14,49,400 is nothing but value in use. It is nothing but present value of future cash flows that you can earn from that particular asset. Present value of future cash flows from that particular asset. Okay. FELCTS, it will be given in the question only. Sale price is of that asset is, say for example, 30 lakhs today and cost to sell is 2 lakhs. Then 28 lakhs will be your FELCTS. So 28 lakhs or 14,49,000, whichever is higher. Got the point? Whichever is higher means obviously I'll go for 28 lakhs. So 28 lakhs is the recoverable amount. That 28 lakhs recoverable amount will be compared with carrying amount of the asset, which is 40 lakhs. Which means your asset is overvalued by almost 12 lakhs right now. So therefore impairment loss will be 12 lakhs because your book value is 40 lakhs right now. What you can recover is only 28 lakhs. So when your carrying amount or book value is 40 lakhs and what you can recover is only 28 lakhs, then you have to reduce the asset value by the balance 12 lakhs, correct? Which is nothing but impairment loss. So therefore impairment loss is 12 lakhs. What is the entry? Very simple. You need to reduce the value of the asset by 12 lakhs. Therefore credit the asset to the machinery 12 lakhs and you will be debiting impairment loss, which will be taken to P&L account. So where this impairment loss will go? It will go to P&L account. It will go to P&L account. So after this impairment loss recognition, your revised carrying amount of the asset will be 28 lakhs. Here, very simple. You have reduced the value of the asset by 12 lakhs. Simple. That's all. Okay. One student has asked me this doubt. That is the reason I've written this in so-called material as well. Because sir, what if the asset value increases to 42 lakhs from 40 lakhs? Because the carrying amount is 40 lakhs now. If the value increases to 42 lakhs, then what you will do? Now, the question itself is wrong, na? Because impairment testing is all about reduction in the asset value. If the asset value increases, why would I do anything? I'll just leave it like that. First of all, question itself is wrong. Ind AS 36 is only triggered when there is a sudden fall in value and standard says only reduction in value should be considered, ignore increase in value. Simple logic. Scope also we have already seen. Are we done with this? So, with this particular example, we have covered completely how to calculate what, Nana? Impairment loss. I hope this is clear. Everybody, confirm me. Now look at this, Nana. Meaning of impairment loss. What exactly is impaired? Very simple. Asset is impaired when the carrying amount, that is in our example, it was 40 lakhs, na, is greater than recoverable amount, which in our example was 28 lakhs. Thereby, impairment loss, which is 12 lakhs, is equal to carrying amount, that is 40 lakhs, minus recoverable amount, that is 28 lakhs. That's what we have done in our example. Pretty simple. Okay. This also you can just check. So in a way, Ind AS 36 is basically a reality check. That's all. Financial statement should not show an asset at more than what it can realistically generate back, either by use or by sale. Either by use, and that is the reason we calculate VIU, or by sale, and that is the reason we calculate FELCTS, and then we see whichever is higher is nothing but recoverable amount, which is RA. And this recoverable amount is being compared with carrying amount. And based on that, we calculate what? Impairment loss. Got the point? Right. Chalo. Okay. Now, this is what we have already done in the example. So there is nothing new that you have seen here. Now, this is going to be interesting. What is this? Indications of impairment. Indications of impairment. This is very important, Anna, because if you can look at the beginning of the example, I said triggering event, na, which attracts Ind AS 36. That is nothing but indications of impairment. So unless there is an indication, You'll not be doing impairment testing every single year. And of course, there are exceptions for that. That also we'll see. Sir, what do you mean by exceptions, sir? Which means there is no need of any indications of impairment to do impairment testing. By default, every single year you'll do impairment testing. Sir, which means what you are trying to say is there are certain assets where you need not wait for triggering event or indications of impairment to do impairment testing, but instead, every single year as a formality, you'll be doing impairment testing. Is that what you're trying to say, sir? Yes, sir. Exactly. Got it? Okay. Now, so what kind of indications of impairment that you have got? You have got two types, external, internal. This is like warning signals. Okay. Now, naturally tell me, external indicators means outside the company that negatively affect your asset value. That's why we are going for impairment testing. Now, if it positively affects, why would I go for impairment testing? If it negatively affects only, I'll go for impairment testing. Clear? Internal indicators means inside the company, which means something happens inside the company which will negatively affect your asset value. External indicators means something happens outside the company which will again negatively affect your asset value. Whether something happens inside or outside, depending upon that, you have external indicator or internal indicator. But the common point is both will affect your asset value negatively, not positively. Clear? Okay, sir. Now, coming on to external indicators, what do we have? First one, adverse technological, market, economic, or legal changes. Technology changes suddenly in such a way that it reduces your asset value. There is some market changes. Suddenly supply would have got increased, therefore your asset value is reduced. Economic changes, legal changes. Suddenly there is a legal, new statute that has been given by the government. Eventually it bans the machine that you're using. Are you able to understand? So because of these reasons, all of a sudden your asset value drops significantly. So it affects your asset value negatively. So adverse technological, market, or economic or legal changes. External environment can reduce demand or reduce ability to operate profitably through your asset. Example, say for example, there is a new law which bans a chemical ingredient. Automatically your production line becomes less useful, and that is an impairment indicator. Got the point? Or say for example, a new government regulation bans a chemical plant itself. Automatically plant ka value is what? Impaired. Simple. Impaired means what? Significantly reduced. When I say chemical plant value is impaired because of the ban by the government or restriction by the government, whatever it is, because of the law introduced by the government, then tell me, when I say plant value is impaired, what does it mean? Its value is significantly reduced. Its value is significantly reduced. Okay, next. Significant decline in the asset's market value. For example, there is a property value crash, property price crash in a specific city. Because Ind AS 40 is covered, na? Then what will happen? You have to do impairment testing. Understood? Some sort of recession has come, and because of that, naturally, what happens? Your asset value goes down all of a sudden because there is no demand whatsoever. When it comes to recession, what happens, Nana? People will start spending money only on their priorities. Okay, the food, the basic things. They'll not be going for luxurious stuff, right? Investment in property is also a luxury in that particular scenario. Okay, next. Increase in market interest rates affecting discount rate and lowering what? Recoverable amount. Now, this is interesting. So let's focus on third point. I gave you an example as well. So what is this third point? See, Anana, I'll write it so that you'll understand it better. Market interest rate has got increased. Okay. The market interest rate has got increased. I mean, what will happen? Generally, this interest rate only will be used as discount rate. So which means discount rate also has got increased. Now, this discount rate will be used to discount cash flows of the asset. So naturally, when interest rate increases, your discount rate also will increase. For example, here, what is the discount rate that we have used? 10%. Suppose interest rate increases to 15%. Let's say this also becomes 15%. Then this will reduce, which means the multiplied value will reduce. Correct? Which means value in use will reduce. Are you able to understand? So discounted cash flow of the asset also will reduce, which means VIU value will reduce. So suppose RBI increases the interest rates, RBI hikes the interest rate. Naturally, what will happen? The present value of the future cash flows from the asset, which will eventually be calculated as value in use, that will also be reduced. Naturally, when this gets reduced, what will happen? Your value of the asset also gets reduced. That is an indication of impairment. That's what I'm trying to say. So when interest rate increases, why it is referred as indications of the impairment? Because of this reason. Got it? Chalo. So these are all external indicators, Nana. Next set, what we have is internal indicators. What are they? First one, obsolescence or physical damage. What do you mean by obsolescence or physical damage of the asset? Now remember, internal indicators means this happens inside your company. This happens inside your company. Obsolescence or physical damage. What about that? Say for example, a factory machine breaks down. Sir, what do you mean by breaking down? It just breaks down, Nana. Or for example, a old software has become obsolete after a, say for example, something like that. Because of new operating system, the old software has become what? Obsolete. Then suddenly the value of the asset drops. You can see the examples over here. Obsolescence or physical damage. A machine is damaged in a fire, say for example. Even after repairs, efficiency drops, which means recoverable amount may be lower. Maybe. These are all indicators of impairment. I'm not confirming that there is impairment, because here also, because of this third point, value in use of the asset reduces. So there may be indicators, there may be indications of impairment. As a result, it is a triggering event. As a result, I'll calculate recoverable amount, which is nothing but value in use or FELCTS, whichever is higher. Na? So FELCTS, if it is unaffected, then ultimately there might not be impairment as well. Indicators of impairment means there may be a chance of impairment loss. It is not a confirmation. So all these things are like, it creates doubt. And that doubt has to be verified eventually. So just because there is an indicator, that does not mean that 100% there will be an impairment. Please try to understand. All right. I thought there was a focus issue. That's okay. Did you understand what I'm trying to say? Just because there is an indicator of impairment doesn't mean that impairment loss will be there for sure. It just creates a doubt. After that, you need to verify by calculating recoverable amount. The recoverable amount is nothing but value in use or FELCTS, whichever is high. That's all. The obsolescence or physical damage. Then you have significant adverse change in how the asset is used. Sir, what do you mean by that, sir? Look at here. You built a factory line for product A, but you stop product A due to poor demand. Then that entire line becomes idle, which means there is a significant adverse change in how that asset was used. Are you able to understand? Exactly. Or you have some restructuring plan, or you have a plan to dispose of the asset earlier than what is anticipated. Okay. Or a company decides to shut down one of its divisions, for example. Then that division will be at impairment risk, maybe at impairment risk. Then you have to, of course, check for impairment. All these things will create doubts, Nana. They are not confirmations. Indicators of impairment are not confirmations. They create doubts. Just a triggering event. After that, you need to check for impairment. Then officially you confirm by calculating impairment loss and then recognizing that in P&L account. Last one. Internal reporting shows performance is or will be worse than expected. What do you mean by that? For example, actual cash flows from a CGU, cash generating unit. That is not even a group of assets. Okay. We'll see what is that later. Are consistently below budget and forecast are revised downward. So when you are revising the forecast, which means the cash flows, what you initially thought, is much, much higher when compared to what is the cash flows that you're actually getting. Then naturally you have to reduce that forecast. So cash flows gets reduced, which means value in use gets reduced, which means there is a doubt of impairment. Then you do impairment testing. Simple. Got the point? So whenever you see indicators of impairment, the immediate word that has to come to your mind is doubt with respect to significant decline in the value of the asset. Doubt only, not confirmation. Doubt only, not confirmation. This you have to keep it in mind. Are we done with this, everybody? Okay, chalo. Now let's come to the next topic. So indicators of impairment are done, external as well as internal, and I told you clearly that these will create only doubt. They are not official confirmation. Once doubt is created, or you can call it as triggering event, then eventually you go and do the impairment testing. After that only we'll know whether there is a real impairment loss or not. Okay. What is the next one? Frequency of impairment testing. So what do you mean by frequency of impairment testing? when should I do impairment testing? Sir, just now you have told us, sir, whenever there is an indication or triggering event, then you will do impairment testing, as simple as that. So the general rule is that you test impairment when there is an indication of asset is impaired. Sir, I have purchased an asset today, sir. Almost for 4 years, there is no external or internal indication with respect to what impairment. Then you don't do impairment testing, as simple as that. Sir, 4 years I will not do, 8 years also you will not do. That's all. General rule is that. So which means every year do I need to do impairment testing? No. Sir, I need to wait for indication of impairment? Yes. I need to wait for the triggering event? Yes. Sir, I did not get any triggering event, sir, last 4 years. 4 years ho gaya, sir. 5th year I'll do impairment testing. No, that's not the general rule. So Ind AS 36 doesn't want companies to do heavy valuation work every single year for asset unnecessarily. So the default approach is test only when there is a reason. What is that reason? Triggering event. What is the triggering event? Indications of impairment. Is that clear? Everybody? Fantastic. But is there an exception for this general rule? Yes. Yes. What do you mean by exception? First of all, what do you mean by general rule? Sir, every year I need not do impairment testing unless there is a indication. Correct. What is an exception for that rule? Which means every year you have to do impairment testing. Sir, for what kind of assets? First one, intangible asset with indefinite useful life. Second one, intangible asset not yet available for use, which is under development phase. If you could recollect Ind AS 38. Goodwill acquired in business combination. In these three cases, mandatorily annual testing has to be done. Sir, which means in these three cases, I should not wait for indications of impairment. No, every single year you have to do mandatorily. Why, sir? Nana, intangible asset with indefinite useful life means what? Sir, life is unlimited, sir. Because life is unlimited, every year you need to check for its value so that it is not overvalued any single year. Intangible asset with definite useful life, that is different. There the general rule will apply. Sir, there is an intangible asset, sir, software, sir. The life is 5 years, sir. This is definite useful life. In this case, what should I do, sir? This exception will not apply. You need to wait for indication of impairment. Okay, sir. Sir, there is a software, sir, or there is a trademark, sir, for which the life is unlimited, sir. Indefinite useful life. Then you have to do mandatory annual impairment testing. You should not wait for triggering event. Okay, sir. Intangible asset not yet available for use, under development. Under development means it has not yet started generating cash, Nana. So therefore, I need to check whether it is overvalued or not. This we have already seen in Ind AS 38. I don't know whether you can recollect or not. If you have revised, you should know that this point we have already seen in Ind AS 38. Okay. Goodwill acquired in a business combination. Anyway, you are not doing amortization. So I have to check whether goodwill is at correct value or not. Therefore, I will do mandatory impairment testing. Because it is not depreciated. Not depreciated means because goodwill is an intangible asset, we call it as amortization. But tangible assets, we call it as depreciation, correct? That is the thing. So there's a logic for everything. So when it comes to frequency of impairment testing, the general rule is we'll not do it every single year. We will do it only when there is a indicator of impairment, external or internal. That is nothing but triggering event. But there are exceptions in case of intangible asset with indefinite useful life, intangible asset under development, goodwill under business combination. In these three cases, every single year you have to do impairment testing. You need not wait. You should not wait for triggering event. Got it? Finished? All right. Fantastic. Chalo. All right, Nana. Let's continue. So we are done till here. Internal indicators and external indicators are done. And then we have also covered frequency of impairment testing. The general rule is that we don't test it every single year unless and until we get some sort of indicator, whether it is external or internal. That is nothing but we call it as triggering point. Okay. And there is an exception for that. There are three exceptions. One is intangible asset with indefinite life. The other one is intangible asset which is under development. And the third one is goodwill under business combination, which is 103. Okay. Chalo. Now, measurement of recoverable amount. This we have already covered, Nana. So nothing new over here, which is higher of FELCTS or value in use. Why higher? Because you want to be optimistic. This also we have discussed. Okay, next. How to calculate FELCTS? This also we already know, but anyway, just for a formality purpose, we'll see it one more time. Okay. How to calculate value in use, that we already know, which is nothing but present value of discounted cash flows, that we have already seen, right? What about FELCTS? Let's try to understand this. Pretty simple. Fair value, we already know how to calculate the fair value, right? It is as per Ind AS 113. Ind AS 113 we have already covered, okay? So you calculate the fair value as per Ind AS 113. All you have to do is that you just need to reduce from fair value cost to sell. Sometimes cost to sell can also be called as cost of disposal. So once you do that, you'll be getting FELCTS, correct? Right? Okay. What is cost to sell? Very simple. Transaction cost like legal cost, stamp duty, cost of removing the asset from that particular place. Because when you want to sell, you have to remove it, na? Selling expenses, dismantling cost, packaging cost, all this cost, all these are examples of cost of disposal or cost to sell, which means any incremental cost which is directly attributable to the disposal of the asset comes under cost to sell, which means if I need to sell the asset, I have to incur this cost for sure. Then only that will be considered. There is one important point over here where students are often getting confused, that is valuation fee. Sir, what is this valuation fee? Those are all big assets, big machines. After some 4 or 5 years of usage, let's say the life of the asset is 10 years. Now you have decided to sell it, or you haven't decided to sell it, you are doing impairment testing. Okay. So to do impairment testing, obviously you need to find out recoverable amount. To find out recoverable amount as per Indian Accounting Standard 36, you need to find value in use or FELCTS. To find FELCTS, you are trying to find out the fair value. Also, you need to reduce cost to sell. To find out that fair value, you are trying to do valuation by an expert, and that expert will charge valuation fee. This valuation fee, is it cost to sell or cost of disposal or not, is the discussion. Tell me one thing. Just because you have done valuation, is there a rule that you have to sell it for sure? You're just trying to figure out the value. That doesn't mean that you will sell it for sure, na? Are you able to understand? Therefore, valuation fee will not be considered as cost to disposal. That is the point that you need to understand. Everybody, yes? Because the valuation fee would be incurred anyway for reporting purpose. Therefore, you are not incurring this exclusively for the purpose of selling. Even for reporting purpose also, you need to incur valuation fee, because once you incur valuation fee, you will be finding out the value of this particular asset. That anyway you have to do it, irrespective of whether you have an intention to sell or not. Therefore, this should not be included under cost to sell while calculating FELCTS. That is a point. Clear? Everybody? Okay, sure. Why valuation fee is not included? Valuation fee is to measure fair value, not a cost that is necessarily required to sell the asset. It is more like an assessment cost, not disposal cost. Right. So now I'll give you clarity for cost of disposal. Let's discuss that separately. Go for notes. Okay. Now I should write it in Ind AS 36. Now you write along with me. Okay. I'm just trying to give you a little bit of extra clarity. Okay. Ready? Okay. So what is that we are going to write? Cost of disposal or cost to sell. First, what is the concept? Because concept also you have to write it while writing the answer. The incremental cost that are directly attributable. Okay, for the disposal of the asset. You can call it as disposal of the asset, or you can also call it as, say for example, for selling the asset. Whichever way, whichever sentence you want, you can use. So incremental costs that are directly attributable for the disposal of the asset, we call it as cost to sell. Okay. So examples for cost to sell, already we have seen. Legal cost, is it cost to sell? Yes, because you will be incurring that only when you're having a thought process to sell the asset. Then stamp duty. Stamp duty, literally this is incurred on sale transaction, na? Cost of removing the asset from the location. This also we have seen it as an example, cost of removing the asset from the location. cost of removing. हो गया. Selling expenses, brokerage commission. So broker will find out the buyer. So all these costs you will incur only if you have an intention to sell. Fine. Then what will not be included? I'll put an into over here so that you'll understand what will not be included. First one is valuation fee. Because valuation fee, or sometimes it is also called as appraisal fee, these would be incurred anyway, Nana, to find out the value of the asset. That's all. It doesn't mean that for sure you'll be selling it, because for reporting purposes also in your financial statements, you have to show fair value. Na? For that also, anyway, you'll incur valuation fee to find out the fair value of the asset so that you can report it in your balance sheet purposes. You got the point? For reporting purposes also we do. So there is no rule that you'll be selling it for sure just because you have incurred what? Valuation fee. They are not directly attributable for disposal of the asset. That is the reason it is not included. Next. Finance cost. This is very easy. Is it directly attributable to the disposal of the asset? No. Income tax. Income tax expense on disposal. I'm just giving you examples. Will this be included? No. All these three are not included. This is included for cost to sell. Got the point? Most important examination point is valuation fee only. Got the point? Are we done with this? Shall we move on? Right, fantastic. Next. So cost to disposal is done. What do you have to remember from conceptual point of view? Incremental and directly attributable. These two words you got to remember. Then examples, if you just have an idea, it's enough. But what you have to specifically remember is valuation fee is not included in cost of disposal or cost to sell. That's all. When you're calculating FLCTs. Okay. You can just go through this example. Next. Value in use, we already know this. Okay. So present value of future cash flows expected from the asset. Whatever the cash flows that the asset generates. Okay. What is present value? Once you discount the cash flows which are happening in future, you discount it and bring it to the present value. We call it as present value. Fine. Okay. Now here, while calculating value in use is nothing but present value of future cash flows that are discounted. Correct? So what are the important words over here? One is you need to estimate your future cash flows. Okay. Another one, discount rate to be used. What discount rate I need to use? These two are very important. So let's focus on these two things. This is very important, Nana. So now we are trying to understand how to calculate value in use. In the example, I just gave you the numbers. I gave you some cash flows. I gave you some particular discount rate. We have discounted it and we have calculated value in use. It was very easy. Now we are going to learn how to calculate those numbers, how to expect or how to predict future cash flows that you are going to earn from using the asset. How to do that. And also how to choose the discount rate. What discount rate must be chosen. Those are all the things that we are going to learn right now. Okay, if you guys are ready, we'll start. Okay, so two things we are going to focus right now. One is estimation of expected future cash flows. The other one is discount rate to be used. Let's start with how to estimate future cash flows. On the left side, all the things that you should be including while calculating future cash flows. On the right side, you have all the things that you should be excluding while calculating future cash flows. What are these things? One by one, we'll see now. All right, Nana, let's continue. In the last session, this is where we have stopped. Estimation of expected future cash flows. Correct? Right. Okay. So now what are we trying to do? We are trying to calculate value in use. Now to calculate VIU, we know that we need to discount the future cash flows at a discount rate. That's all. So that we'll be getting that present value. Okay. So now first we need to have an idea with respect to what cash flows should be considered and what cash flows should not be considered. That's what we're going to see over here. Now it's very easy, Nana. See, when it comes to calculation of value in use of a particular asset or a machinery, whatever as the case may be, by using that particular asset, how much is the revenue that you are generating? Are you able to understand? You need to consider that obviously. So it includes cash inflows from the continuing use of that particular asset. In simple example words, sale receipts generated using that particular machine. Nothing but revenue. Sometimes a particular machine need not generate revenue. All it will do is it will reduce the existing cost. That also will happen. So we call it as savings in cost. So saved outflow is also deemed inflow, na? So that will also be taken as cash inflow. So either it can be revenue or it can be saved outflow, which is nothing but we call it as savings. Okay. What is the next one? Expenses also has to be considered. Because to generate these inflows, you'll have some expenses, na, which is nothing but outflows. That also you should consider. So you cannot take only the inflows. Is it clear? Everybody? We can call it as operating cost, or you can also have maintenance cost, salaries of staff operating that particular machine. Got the point? All those things will be included, which means obviously inflows minus outflows will be there. That is why I've written it as expense. Put it very simple, expense. And finally, you'll dispose of this particular asset at the end of its lifetime. That is nothing but residual value. That also you need to consider. So it's very easy. So what I need to consider, revenue from that particular asset or the savings of outflow from that particular asset. Expenses from that particular asset will be reduced. And finally, residual value. That's all simple. Now, when it comes to what it excludes, which you need to ignore, this is also very easy. Nana. First, what you need to ignore is future cash inflows or outflows from a future restructuring plan which has not been committed. So what is the keyword over here? Not yet committed. Got the point? For example, I'll just give you an example. Let's say management is considering investing in new robotic technology with respect to future. Why? Because this will reduce the existing cost by 40%. Say for example, okay. Now tell me, they are contemplating this. They are considering this. But there is no board approval. Board approval did not happen, which means, can I say this projected savings, because 40% reduction means it comes under this category, Nana, saved outflow. So which means, can I consider this 40% reduction as cash inflow while calculating VIU? The answer is no. Why? Because you have not yet committed. There is no board approval. That should not be considered because it's a question mark. It's a question mark. Therefore, do not consider that. Next, interest and tax expenses should not be considered. Got the point? In which, with respect to what? Discount rate that you're using. See, interest and tax expenses, why you should not be considering? Very simple, Nana. You're already using discount rate. Hello, yes. What is the discount rate that you're using? The discount rate that you're using is cost of capital. Cost of capital will be the discount rate, na? Overall cost of capital. Now, that overall cost of capital also includes cost of debt. Cost of debt is nothing but interest, so therefore interest should not be considered because it is already considered in the discount rate. Next, tax expense. Why it should not be considered? Very simple. The cash flows what we are taking over here, they are pre-tax cash flows. Got the point? And not only that, the discount rate that you are taking, that is also pre-tax discount rate. So therefore everything should fall in line. Na? Therefore cash flows also will be taking pre-tax. Therefore tax expense will not be considered. So everything is pre-tax. Cash flows pre-tax. Discount rate pre-tax. Therefore tax should not be considered. Why interest expense should not be considered? Because the discount rate already captures cost of capital, and inside the cost of capital you have got cost of debt, and that cost of debt is nothing but it. Got the point? Exactly, Nana. If you include interest in the cash flows and also you include cost of debt inside the cost of capital, then it will double count the interest effect, Nana. With doubling effect will happen. That is the reason interest should not be considered. Got the point? Because in the discount rate, in overall cost of capital, already cost of debt has been included. Got the point? Right. Tax expense, I already told you. Cash flows tax, discount rate also pre-tax. That's all. That's why it is not considered. Very easy. Right? Chalo. Next. Discount rate to be used. This we have already discussed. Cash flows taken are pre-tax. Therefore, discount rate also will be pre-tax. Simple. That's all. Are we done with that? What discount rate you should be taking? It will be market rate, but it has to be pre-tax. It will be market rate, but it has to be pre-tax. Simple. Are we done? Okay. Next one is with respect to the forecast period, which means while calculating VIU, you'll be calculating future cash flows. Na? That you'll be discounting. Now that future cash flows you'll be calculating for how many years? Let's say the life of the asset is 10 years. You'll be calculating it for 10 years? No. What the standard says is cash flow projection should be based on forecast covering maximum period of 5 years, not beyond 5 years, unless a longer period can be justified. So by default 5 years tak theek hai. If it is beyond 5 years, you have to justify why it's going to be beyond 5 years. Got the point? Why? Because the standard believes that the further you go away in terms of number of years in future, the further the complications will be very high. Why? Because next year I can predict, Nana, with a little bit of accuracy. Second year, accuracy reduces. Third year, accuracy further reduces with respect to your prediction. Sixth year, seventh year, eighth year, the accuracy further reduces. Therefore, they say till 5 years it's fine, TK. Beyond 5 years means you need to justify why you're going for it while calculating. Got the point? Because simple, Nana, you're going based on projections, na? Projections of cash flows. If the number of years increases, what will happen to the projections? This will become speculative, na? Speculative, you can also call it as unreliable. The risk factor will increase, the uncertainty will increase. Got the point? Therefore, this 5-year rule is there. Now, this is important from examination perspective because in exam, this is frequently tested. 5 years while calculating VIU. Clear? Are we done? Any other doubts? Okay. Yeah. With respect to pre-tax, there is one doubt. Simple. You just remember this, Nana. Cash flows will be pre-tax. Discount rate, which is nothing but market discount rate, that will also be pre-tax. That's all. Matching concept. As simple as that. That's all you have to remember. Pre-tax cash flows will be discounted at pre-tax discount rate. The discount rate is nothing but market rate. Got it? Chalo, that's it. Are we done with that? So what should be considered? Revenue or saved cash outflow, expense also should be reduced, residual value inflows also should be considered. What should not be considered? Not yet committed future plans of restructuring, and interest and tax expense should not be considered. For interest, the logic is while using discount rate, you're taking overall cost of capital in which cost of debt is already included. And for tax expense, because we are taking pre-tax cash flows, it should not be included. And when it comes to discount rate also, we are taking pre-tax discount rate. Naturally, tax will be excluded. It will not be included. That's all. Got it? Okay. Now let's come to the next concept, foreign currency future cash flows. Guys are ready? We'll start. Now look at this, Nana. Foreign currency future cash flows, which means, say for example, if future cash flows are in foreign currency, there is possibility for that, isn't it? See, as said, there is no rule that it has to generate all the cash flows in Indian rupees. Probably you have a customer in a foreign country, in US for example. So whatever that you manufacture over here, it is being sold over there. So which means all the future currencies, future cash flows that eventually that you calculate is in foreign currency, in dollars for example. Then how will you calculate VIU? That is the biggest question. For example, first year, you are anticipating some cash flows na, because of sales in dollars. Will you convert that into rupees in the first year itself? Or you gonna wait for all the future years and then you will convert? Then what about the discount rate? Will you apply discount rate in Indian rupees or will you apply discount rate in that particular foreign currency? So all this confusion, that is why gonna see what we gonna learn. Right, now see here. If future cash flows are in foreign currency, then first step is first compute the present value using foreign currency discount rate. Okay. So which means you'll be having cash flows in foreign currency, say for example in dollars, and using foreign currency discount rate. Got the point? Not Indian rupee discount rate, foreign currency discount rate. You first convert this, okay, into what? Present value. Now this present value will be in dollars only because you did not convert that into rupees. What you have done is you have just discounted it using foreign currency discount rate. You got the point? So now already you've got present value in dollars. Now you need to convert that into rupees. Are you able to understand? Presuming that yours is an Indian company, you got to convert that into rupees. Got it? How you'll be converting? You need an exchange rate for that. What exchange rate you'll go for? Spot exchange rate is that you'll go. What is the date? Value in use calculation date will be there now. On that date, whatever the exchange rate will be there, that exchange rate you'll be multiplying this so-called present value, which is in dollars, which is already discounted. So let me tell you again. See here. Your cash flows are in dollars, for example. First, you discount it using what? Foreign currency discount rate. Let's say it is 5%. Say, for example, So 1 divided by 1.05 or something like that, you discount it. Let's say you'll be getting somewhere around, let's say $7,000. Now already this is in present value. Now you need to multiply that with exchange rate. So you'll be going for spot exchange rate on the date on which you are doing VIU calculation. Let's say on that date it is 90 rupees. Then you multiply $7,000 into 90 rupees. You get your so-called cash flows in rupees after discount. Nothing but present value of cash flows. So normally, if everything is in rupees, all you have to do is just discount it. But if it is in dollars, you discount it first and then you convert that into what? Rupees. 2 steps you have to do. That's all. I hope this is clear. Right. So the logic is really simple. You discount in the same currency because the discount rate must match the currency cash flows. For example, the currency is in dollars, then your discount rate also should be representing dollars in act. Got the point? Chalo. Are we done with this? Okay, if you want an example, you can do an example. Solving it. Got the example. Say for example, there is ABC Limited. Okay, this is in India. In US, there is a subsidiary for ABC Limited. Okay, XYZ Limited. Got it? It is generating 1 lakh US dollar per year for 3. Okay. Now US dollar discount rate, say for example, it is 8%. And let's say spot rate on the date of VIU calculation, 83 per dollar. So what is the first step you have to do? First, you need to find present value of cash flows. Think, but what are your cash flows? 1 lakh. This is annuity cash flows only now. For all the 3 years, it is 1 lakh. 1 lakh in present value annuity factor at what is the percentage you'll be taking? 8%. That is US dollars discount rate. 8% for 3 years. That is equal 1 lakh into 1 divided by 1.08 equals to G. So how much you'll be getting? 1 lakh 0.577. So which means dollars 2,57,700. This is dollars still. But it has been discounted using foreign currency discount rate, which is nothing but 8%. Now step 2 is to convert that into Indian rupees at spot rate. So 2,57,700. What is the spot rate? 83 per dollar into 83. Comes around 13,89,100. That's all. Very simple. Nothing is there. Very simple, Nana. I hope this is clear. Gave you an idea? Right. Fantastic. Let's move on. This is another important point, Nana. Let's focus. Look at this particular term. There are certain circumstances where FELCTS or VIU cannot be calculated. Sir, why are you talking about FELCTS or VIU? Because to calculate impairment, you should be comparing the carrying amount of your asset with recoverable amount. How to calculate recoverable amount? It is FELCTS or VIU, whichever is higher, correct? What if one of them cannot be calculated? Then how will you calculate recoverable amount? Sir, what is there, sir? Say for example, VIU is available. Value in use, you can calculate from that particular asset. But FELCTS is not available. What will I do? Very simple, only VIU is available. Na? Therefore, take VIU. If VIU is available, but FELCTS cannot be determined, then recoverable amount is nothing but VIU. Okay, very easy. It works other way around also, na, sir. The logic is very simple. Na? If FELCTS is available, but VIU cannot be determined, then recoverable amount is equal to FELCTS. Like that you should not think. If FELCTS is available, VIU cannot be determined. What is VIU? Cash flows from that particular asset discounted, correct? If you cannot determine cash flows from that particular asset, which means that particular asset is not generating independent cash flows on its own, then it has to be treated from CGU point of view. CGU means cash generating unit. When individual asset or machinery cannot generate cash flows on their own, then you try to set them with a group of assets and that group of assets will be considered as CGU. Nana, there are 5 machines, Nana, or let's say machine 1, machine 2, machine 3. Machine 2 cannot generate cash flows on its own. It just takes the input from machine 1, gives it to machine 3. In that case, you cannot calculate VIU of machine 2 now. If you can't calculate VIU of machine, then immediately shift to CGU concept. What is CGU? Cash generating unit. All the 3 machines put together can be called as one CGU. Are you able to understand? So what is that CGU? All those things we'll see later. But right now what you need to understand is that to calculate impairment, compare carrying amount of the asset with recoverable amount. To calculate recoverable amount is FELCTS or VIU, whichever is higher. If FELCTS cannot be calculated, then it's very simple. Recoverable amount is nothing but VIU. In this case, there is no problem because you are able to calculate VIU, which means that particular asset is capable of generating cash flows on its own. But the problem comes when you are not able to calculate VIU and only FELCTS is available. In that case, straight away, you cannot say that recoverable amount is equal to FELCTS. No. If you can't calculate VIU of a particular asset, it means that asset is not capable of generating cash flows on its own, which means it has to be converted into a group, which means CGU concept will apply. What will apply? CGU concept will apply. What is CGU? Cash generating unit. Which is nothing but a group of assets which can generate independent cash flows. What is that? We'll see later. But this is a concept right now you have to remember. Clear? Hello. Next. Okay. Let's try to understand what is the treatment of impairment loss. Do we know how to calculate impairment loss first of all? Yes, sir. Very easy. Just need to compare carrying amount with what? Recoverable amount. Recoverable amount is nothing but FELCTS or VIU, whichever is higher. So if there is an impairment, which is nothing but you write down the value of the asset, what you will do with that impairment loss, sir? It will be transferred to P&L account, sir. Correct only. But not straight away. What do you mean by not straight away? Which means by default, the moment you calculate impairment loss, do not take that impairment loss to P&L account. What should I do? Very simple. Check whether there is any valuation surplus on the same asset in the OCI. There might be a chance, na. You would have revalued that asset. You would have followed revaluation model as per Ind AS 16 PPE. And as a result, the revaluation surplus would have been there inside OCI for the same asset. And the same asset, which means same asset value has been increased earlier. And the same asset value has been reduced now, means whatever the value that you have increased earlier, that should have been set off now. It should not be taken to P&L account directly. You understand what I'm trying to say? See, I'm going to go with an example so that you'll understand. Okay, just a second. I'll go with the example and then I'll come back over here. Here, listen carefully. There is machine A. Okay, this machine's carrying amount is 8 lakhs. Recoverable amount is 5 lakh 50. It's nothing but FELCTS or VIU, whichever is higher. Now tell me, is there impairment loss? Yes. How much? What is the difference? Lakh 50. Now straight away I'll take this to P&L account. Like that you should not think. First check whether this asset has been revalued earlier and there is a revaluation surplus in OCI. Sir, there is revaluation surplus, sir. For the same asset, sir, just now I've checked. It is 1,80,000. Then first, this impairment loss should be set off with revaluation surplus. Impairment loss debit to the extent of 2,50,000. First, to reduce revaluation surplus, how much it is available? 1,80,000. So that 1,80,000 is gone. It is removed from OCI. Still, there is a pending loss of 70,000. To that extent of 70,000, you can go for what? Sorry. First, impairment loss should reduce what? Machine to machine value. Sorry, Nana. 2,50,000. After that, revaluation surplus should be debited to the extent of 1,80,000 and P&L account should be debited for the balance 70,000 to impairment loss. Sorry, Nana. 2,50,000. So the moment I've calculated impairment loss of 2,50,000, first what you guys need to do is that you check whether there is any revaluation surplus or not. If it is there, first you need to set it off with that. So what I'll do is that first impairment loss, to that extent machine value has to be reduced. That entry is passed. I've credited the machine, therefore machine ka value has got reduced. Impairment loss is debited. Okay. Now this has to be transferred to P&L account. Now usually what will I write? P&L account debit to impairment loss normally. If there is no revaluation surplus. If there is revaluation surplus, then you will not be debiting the P&L account by the entire impairment loss. Instead, first you will debit revaluation surplus and remove it completely. Then the balance only, to that extent you will be debiting your P&L account. The entire value of impairment loss will be extinguished. Got the point? Is this clear? So that is what we have discussed as a concept over here. Impairment loss is normally recognized in P&L account. This is general rule. But there is an important exception. When the revaluation surplus exists, if there is any revaluation surplus balance in OCI, recognize impairment loss in OCI first, which means set it off with the revaluation surplus to the extent of revaluation surplus available, which is 1,80,000 in our example. Beyond that, any remaining impairment loss is there, that will go to P&L account and it will debit the P&L account. Got the point? Right. Logic and example, you can see it over here. Already I've explained you. I've explained the entries as well. Impairment loss to asset account. First you reduce the value of the asset. Then revaluation surplus debit, P&L, anything remaining to impairment loss. This also I've explained. Are we done? Next. Another important point is, what will happen to the depreciation after impairment? What do you mean by depreciation after impairment? Very simple. Say for example, asset ka value is 8 lakhs. Okay. Its value is reduced down to 5,50,000 after impairment. Now what is the revised carrying amount? 5,50,000. The remaining life of the asset is, if there is no impairment, then my depreciation would have been 8 lakhs by 3 years, correct? But because the value has been reduced from 8 lakhs to 5,50,000, now the depreciation will be 5,50,000 divided by 3 years, which will be 1,83,333. So it is not based on the original 8 lakhs. If there is no impairment, it would have been 8 lakhs divided by 3 years. But because there is impairment, it is 5,50,000 divided by 3 years, which means after impairment, the revised carrying amount after impairment divided by balance years that is left over will be your new depreciation per year. Clear? Done? All right. So all the simple concepts are finished, Nana. Now we'll be entering into called cash generating unit. Now hereafter things will get very interesting. So I want you guys to have complete focus over here. If you guys are ready, we'll start. Cash generating unit. Yes. All right, Nana. So this is where we have stopped. We have covered till here and we have stopped with the cash generating unit. So let's start with this concept called CGU. So what is CGU? Let's try to understand. Then again, we'll also try to understand what is the purpose behind that. The CGU means here, as I've highlighted, smallest identifiable group of assets capable of generating independent cash flows. See, first of all, when we'll talk about CGU, for example, there is a machine. If this machine or an asset cannot generate cash flows on their own, then we will see it from the perspective of a group. Okay, as a single machine, let's say this is machine 3. If machine 3 cannot generate cash flows on its own, that is nothing but we call it as independent cash flows, then let us look at it from a group of machines point of view. A machine 1, machine 2, machine 3, machine 4. Now all these 4 machines put together, am I going to generate independent cash flows? If the answer is yes, then this group of machines will be referred as CGU. What do we call? Cash generating unit. You understand the point? So a smallest identifiable group of assets, that is in our example M1, M2, M3, M4, capable of generating independent cash flows, which means on their own. Okay. Now the next question is, first of all, why do we need CGU? Very simple. Sometimes an individual asset's recoverable amount cannot be determined. Why do you need recoverable amount? Why are we talking about that? Recoverable amount means what, Nana? Exactly. FELCTS or value in use, whichever is higher. You understand the point? Now, if you're not able to calculate value in use, then obviously can you calculate recoverable amount? No. That's what Ind AS says, right? If you can't calculate FELCTS, still with VIU, you can calculate recoverable amount. That's what we have seen. I hope you guys remember that. If VIU is available, FVLCTS is not available, then recoverable amount is nothing but VIU. But if you cannot calculate VIU, then obviously you should go for CGU concept. This is what we have seen already. So VIU is very important, value in use, which is nothing but present value of the future cash flows from that particular asset. So which means if you can't calculate cash flows, independent cash flows from that particular asset, you cannot calculate VIU, because VIU is nothing but present value of future cash flows from that particular asset, correct? If you cannot calculate VIU, then you can't calculate recoverable amount. If you can't calculate recoverable amount, then you cannot calculate what? Impairment testing. That's how the link is. Or therefore, if a particular asset cannot generate its own independent cash flows, then you cannot find out present value of cash flows, then you cannot find out VIU, then you cannot find out recoverable amount, then you cannot do impairment testing. So that is the loop that we are stuck. Therefore, we come to a concept called CGU, where if an individual asset cannot generate cash flows on its own, then we'll see it from group of assets point of view. That's all. That group of assets which can generate independent cash flows, we call it as what? CGU. Got the point? So why do we need CGU? Sometimes individual asset recoverable amount cannot be determined. Why you cannot find out recoverable amount? Because that asset will not generate independent cash flows. If there is no cash flows, there is no present value of cash flows, there is no VIU, there is no recoverable amount. That's all. Clear? Okay. Now, this concept we'll see later, why goodwill and corporate assets are tested at only CGU level. Let's go with examples first. Okay. CGU, which is nothing but group of assets that generates independent cash flows. Okay. Case by case we'll go. In each and every case, we'll try to indirectly, we are solving questions only, but different kind of scenarios we'll try to cover, so that we cover all different types of problems that has been given by your ICA indirectly by solving these cases. First case, cash generating unit, okay, without goodwill and corporate assets. In the first example or first case, we are not going to have goodwill as well as what, Nana? Corporate assets. All right. If goodwill and corporate assets are there, then what is the issue? That we'll see later. That will come back and we'll see here. Right now, we are not covering this because for first example, that's not necessary. Okay. Now, if there is no goodwill, if there is no corporate assets, goodwill means you guys know. Sir, what do you mean by corporate assets, sir? Head office building. Corporate assets means head office building, Nana. Something like that. Centralized IT. Centralized IT infrastructure. This is also what? Corporate asset. You understand the point? Just I'm giving you examples. I'm not trying to explain what is a corporate asset. Right now, just try to remember, okay, corporate asset means centralized IT infrastructure, head office building, something like that. That's enough. That's enough. Okay. So CGU without goodwill and corporate assets means there is no goodwill, there is no head office building or what? Centralized IT infrastructure, right? Now, in that case, what you have to do? Very simple. Whenever you come across something called impairment loss, because in CGU you will have multiple assets, this impairment loss has to be allocated to those multiple machines in the ratio of carrying amount of those machines or assets, as the case may be. Sir, what do you mean by that? For example, let's say the CGU is PK Sir classes setup. PK Sir classes setup is a CGU, cash generating unit. Why? Because it's a set of so many machines. For example, you have a system, that's a mission, AC, that's a mission, camera, that's a mission, iPad, that's a mission. You understand the point? So all these missions put together, it can generate independent cash flows. Therefore, can I call this as a CGU? Yes. Okay. Now, PK Sir classes setup is there. Okay. How many missions we have got here in example purpose? Camera I have taken, laptop I have taken, mic I have taken. Okay. All these three put together, we call it as CGU. You have got 3 missions. Okay. What is the carrying amount of these missions? Whatever that is there in your books. This much, this much, this much. For example purpose. Total carrying amount of the CG is how much? 1400 TK. Now, when you calculate recoverable amount for the entire CGU, it is only 1120. Okay. Which means there is an impairment loss. Yes. How much is that? 280. Okay. But 280 is for all the 3 assets. For the entire CGU, 280 is the impairment loss. Now, how will you distribute this to individual assets? Very simple. In the ratio of their carrying amount, because there is no goodwill, there is no corporate assets. Sir, which means goodwill and corporate assets is there means things will change? Yes, it will change. As of now, there is no goodwill, there is no corporate assets. Clear? Therefore, what you will do, take this 280, apportion that in the ratio of carrying amount. What is the carrying amount ratio? 4:8:2. Or in other words, 2:4:1. Apportionate 280. In that ratio, if it is apportioned, you get 80, 160, 40. Okay, reduce that from the existing carrying amount because impairment loss has to be reduced. So 400 minus 80, 320, 800 minus 160, 40, 200 minus 40, 160. This is your revised carrying amount. Well, that's all. So when there is no goodwill and the so-called corporate asset, all you have to do is that find out impairment loss for the entire CGU, apportion that in the ratio of carrying amount of the assets that are existing. That's all simple. Okay. If there is goodwill, then what is the situation? Let's try to understand this now. Goodwill. All right, Nana. Now, coming on to goodwill and corporate assets, the logic is the same. Now listen carefully. What is the logic behind this? The logic is, tell me one thing. Does goodwill on its own, you know what is goodwill, right? Yeah. Does goodwill on its own generate any independent cash flows? The answer is no. That good name of your company can enhance the sales. That's all. It can't generate cash flows on its own, correct? Similarly, when it comes to corporate assets as well, like for example, I'm talking about head office or IT infrastructure, what it will do is they contribute to the cash flows of some other assets or multiple assets for that matter or multiple CGUs, right? They contribute, they help them, they assist them. But goodwill and corporate assets on their own, they don't generate any cash flows. Got the point? So therefore, what will be the treatment? This goodwill, because they can't generate cash flows on their own, will be allocated to CGUs as an individual impairment test not possible. Why? Because why individual impairment test is not possible? Same logic what we have gone to asset earlier, right? So what did we say, Nana? When it comes to certain assets, when they can't generate independent cash flows on their own, we can't do impairment testing individually for that particular asset. That is the reason we go for CGUs, correct? Same logic applies here as well. If goodwill or corporate assets cannot generate independent cash flows on their own, then obviously you can't do impairment testing. And that's why you go for CGUs. As simple as that. You go for which concept? CGU concept. Okay. Now, when it comes to different types of cases or scenarios, we can broadly classify this goodwill into two categories: allocable, unallocable. Allocable means you can divide that, you can apportion or distribute the goodwill to multiple CGUs. Unallocable means there is no suitable basis for you to distribute, allocate, or apportion this goodwill to what? Multiple CGUs. Either you can distribute or you can't distribute. Clear? If you can distribute, if it is an allocable goodwill, that is the keyword, so you have to remember it as allocable only. Don't write distributable or something like that or apportion something, because in your standard same word has been used. If it is allocable goodwill where you can distribute the goodwill to multiple CGUs, then again it can be further classified into two types. One is that goodwill, is it giving benefit to one single CGU or is it giving benefit to multiple CGUs? If it is giving benefit to one single CGU, very easy. You allocate the entire goodwill to that particular CGU. That's all. Allocate that goodwill to that particular CGU and then you allocate impairment loss to that single CGU as first to goodwill, then remaining loss in the ratio of carrying amount of other assets. Now here, don't try to get confused. Very easy. If there is no goodwill or corporate assets, how will you allocate your impairment loss? Sir, very simple, sir, in the ratio of carrying amount of the assets. That's what we have already seen in case 1. Yes, sir, it's very easy. Now, if there is goodwill, what you will do? Sir, now also the entire impairment loss has to be allocated to all the assets. One more asset is added, that is goodwill, which is an intangible asset. So, the order of allocation will be, first you will start with goodwill, finish off the allocation to the entire goodwill that is available. After that, you'll go for the rest of the impairment loss will be apportioned in the ratio of carrying amount of the assets. Clear? Again, I say it's very simple. First, you allocate it to the goodwill. Whatever is left over in the ratio of carrying amount of assets. Simple. Sir, what is that, sir? We'll see an example here. Benefit to single CGU. That's what we are saying. It comes under allocable goodwill. Benefit to single CGU. Look at this case. In this CGU, you have camera, laptop, mic, 3 assets plus goodwill. Okay. Carrying amount will be given in the question itself. Total carrying amount of the CG. Okay. What is the recoverable amount? 1,260, which means the impairment loss is 380. Usually what we'll do with impairment loss, if there is no goodwill, this impairment loss will be allocated to all the assets in the ratio of their carrying amount. That's what we have seen in case 1. Now, because there is goodwill, what will be our order of allocation? First, everything will be allocated to goodwill. How much goodwill is available? 240. Entire 240 will be allocated. Which one? Impairment loss. How much goodwill is available, that much impairment loss will be allocated. So out of total impairment loss of 380, 240 will be given to goodwill because that much is available in goodwill. Entire goodwill is gone. Now how much is left over? First you have allocated to goodwill. So 380 minus 240, 140 is left over. This 140 REM means remaining. This 140 REM means remaining will be allocated to camera, laptop and mic in the ratio. What is the ratio? 4 is to 8 is to 2 or 2 is to 4 is to 1 in that ratio. That's what we have got over here. It is allocated. You have got 40, 80 and 20. It's nothing but 140. Correct? And you reduce that, you get your revised carrying amount. As simple as that. Very easy. So first the allocation will go to goodwill and the balance in the ratio of carrying amount. That's all simple. Okay. Now look at case B. In this case, what is happening? Carrying amount is 1800. Recoverable amount is greater than the carrying amount. When recoverable amount is greater than the carrying amount, is there any impairment loss? No. As simple as that. Impairment loss will be there when your recoverable amount is less than carrying amount. In this case, anyway, it is greater than. So there is no impairment loss. That is case B. Okay. So that's what I've written here. Allocate impairment loss to that single CGU. In that case, first you will be allocating it to the goodwill to the extent of goodwill available. Then the remaining loss, which loss? Impairment loss in ratio of carrying amount to what? Other assets. Oh. That is about allocable goodwill where the benefit is available to single CGU, which means whatever the benefit that goodwill is providing, it is providing only to one single CGU. That is this case. Sometimes goodwill also will give benefits to multiple CGUs. That is nothing but more than one CGU. In that case, what will be the treatment? Very simple. Allocate goodwill to the CGU in the ratio given. Given means where it will be given in the question. The ratio given in the question. And then same treatment as single CGU. Sir, what do you mean by that, sir? Let's try to solve another case. You will understand. Come to example 2. Example 2 also we are talking about allocable goodwill. But in this case, the benefit of that goodwill is available to more than one CGU. And the ratio will be given in the question. Ready? Yeah? Chalo, now. Now look at this, Nana. Benefit is greater than one CGU, which means whatever the kind of contribution or the benefit that is being given by the goodwill, it just not only goes to one CGU, it goes to more than one CGU. In that case, what we have to do, very simple. The ratio will be given in the question. Say, for example, goodwill is 120 and the benefit goes to two CGUs in this example, CGU A as well as B. And the ratio of the benefit is given in the question itself, which is 3:5. Then what you will do? This 120 will be allocated between A and B in the ratio of 3:5. Correct? So therefore, if you do that allocation, 240 into 3 by 5, 240 into 3 by 8 and 240 into 5 by 8. If you do that allocation, you get 90 and 150. 90 of the goodwill goes to A and 150 of the goodwill goes to B. Once 90 goes to A, this again goes to case 1. Benefit given to single CGU. Here we have got how much of CGU for this particular group, how much of goodwill for this particular group, which is 240, right? So therefore, now for this 240, whatever you have done, same thing you will do for this 90 with respect to CGU A. Again, with respect to 150 goodwill for CGU B also, you'll be doing the same thing. So which means only to the extent of allocation we need to think. After that, it's exactly the same as example 1, where the benefit is given to single CGU, which means in this example 1, what did we do? Sir, very simple, sir. We have calculated impairment loss. And out of this impairment loss to the extent of goodwill, entire impairment loss is allocated to goodwill first. And the balance impairment loss, which is 140 in this case, is allocated to remaining assets in the ratio of carrying amount. Correct? Now also we'll be doing the same thing. You calculate your impairment loss first by comparing your carrying amount of the CGU with recoverable amount. Once you calculate your impairment loss of 160, because the goodwill allocation is already being done to first CGU, that is A, out of this 160, first the allocation will be given to goodwill, which is how much? 90. So which means in this 160, 90 is gone. How much is the balance? Sir, 160 minus 90, the balance is 70. That 70 will be allocated to remaining assets in the ratio of carrying amount. It's as simple as that. Same goes with CGUB as well. Now let's see in CGUB what's happening. Total carrying amount is 1950. Recoverable amount is 2200. In that case, there is no impairment loss. Therefore, forget about any sort of allocation. That's all. Here, impairment loss is there. Therefore, we done the allocation. How did we do the allocation? We started with goodwill first, and then we have gone in the ratio of carrying amount for the remaining assets. Correct? Whatever that is left over when it comes to impairment loss. Correct? Whereas when it comes to CGUB, there is no question of impairment loss because your recoverable amount is greater than carrying amount. Therefore, I'll not do any impairment loss. If there is no impairment loss, then all this discussion are irrelevant. Na? All these discussions are irrelevant. It's as simple as that. Got the point? Okay. So that is about allocable goodwill. Then what about unallocable goodwill? Now this is interesting. So I want you guys to focus. Ready? Now, when it comes to unallocable goodwill, the moment you look at the word unallocable, you know that of course it's gonna contribute or give some sort of benefits to multiple CGUs, but you can't allocate that, you can't distribute that. Okay. So benefit to CGUs, ye to pakka hai, but cannot be allocated. So which means there is this goodwill or corporate assets, and then you have got, let's say, 3 CGUs, CGU1, CGU2, and CGU3. Now you can't allocate to any of this, but goodwill is still there, but it can't be properly distributed. That is the problem. Then what will I do? Okay, fine. What you do is, see, we are doing all these things for the sake of impairment testing only now, right? First, what you do, this eventually will solve it in 2 steps. Step 1, test individual CGUs without goodwill. Forget that there is no goodwill. Forget that there is goodwill. You got the point? And then you start testing for impairment without goodwill. We know how to test for impairment without goodwill. All you have to do is that put it in the ratio of what? Carrying amounts of that respective asset. So it's pretty easy. So do that first step as if there is no goodwill, and then try to distribute the impairment loss to all the assets. Okay. Then after that, that is for individual CGUs. Then after that, test all CGUs and goodwill together. Sir, how, sir? For that, we'll go with an example. Now see here. Unallocable goodwill. What is step 1, Nana? Test individual CGUs as if there is no goodwill. Okay. That's what I've written in brackets, without goodwill. So how is that gonna work? Very simple. See here. I have 3 assets over here. Goodwill actually is present, but still I'm taking it as 0. Why? Because I can't allocate it. It is unallocable. Okay. 1400 is the carrying amount. Impairment loss will come only when recoverable amount is less than the carrying amount. Recoverable amount is 1260. Okay. Is there an impairment loss? Yes, 140. Now, when there is no goodwill, what will be your way of apportioning the impairment loss? Very simple, in the ratio of carrying amount. That's all. That is 4:8:2. In other words, 2:4:1. Do that apportionment, and you gave the impairment loss to all the assets. Now CGU A is done. CGU B also do it the same way. Presume that there is no goodwill, although it is there, but we'll presume that it is not there because it is unallocable. But in this case, because recoverable amount is greater than carrying amount, there is no impairment loss itself. Okay. Now this is your first step. So first step, whenever there is unallocable goodwill, you go with the presumption that there is no goodwill and then do the impairment loss allocation. Clear? Okay, in the ratio of carrying amount of the respective assets. Okay, next. Coming on to step 2, we will combine CGU as goodwill. How is that it's gonna work? Very simple. Now the CGU A is there, this will be taken as one asset. One column for CGU A, which includes 3 assets inside. Okay. Next, CGU B will be taken as another column. Next, goodwill will be taken as another column. Now, I can't allocate goodwill to these individual CGUs, but ultimately I can take goodwill separately. Done. Now what you do is that total the carrying amount. Now when I'm taking this carrying amount, this is after impairment. That's what I've put star mark over here. Look at this 1260. What is this 1260? It is after impairment because the actual carrying amount of CGU A is 1400. It is not 1260. Are you able to get me? So 1400. But then we are taking 1260, which means already impairment is done for CGU A. Okay. For CGU B, there is no impairment loss first of all. Therefore, I am taking the normal carrying amount, which is 1800. Now you have taken goodwill. This is unallocable goodwill. Okay, fine. Now, for all these put together, all the CGUs put together, what is the carrying amount? 3300. For all these CGUs put together, what will be the recoverable amount? 3100. Got the point? 3100. Now, after doing all these things, okay, which means is there an impairment loss right now? Yes, 200. Obviously, what is the order of allocation of impairment? If there is goodwill, first it will go to goodwill. How much is the goodwill? 240. How much is the impairment? Not 200 only. It is less than goodwill. So therefore, just do it for goodwill, because with respect to these things, already the impairment loss has been done. So again, you will not be doing for CGU A, CGU B, which means you may have a doubt, sir. Suppose impairment loss is 300. Then goodwill is only 240. Then you will reduce 240. Still 60 is left over. Then that 60 has to be given to CGU A or CGU B, which logically speaking, that's what you have to do. But unfortunately, CGU A, CGU B, already impairment testing has been done. The answer is, whatever the impairment loss that you get in this way, where there is unallocable goodwill, and then you are combining multiple CGUs along with the goodwill and then testing for recoverable amount. In this case, whatever the impairment loss that you get will never ever be greater than the goodwill. So therefore, you need not worry about that. This step is only to reduce the goodwill if there is any impairment loss still, because already you have done the impairment with individual CGUs. Na? Then combining it with goodwill, if still you are getting impairment loss, then that is because of goodwill only. So even though you are showing goodwill at this particular value, even though you are showing goodwill at this particular value, in reality it does not have that value. That is the logic behind this particular step. So therefore, it will not go beyond 240. The so-called impairment loss that you will get in this step will not go beyond the goodwill. Allocated to goodwill only. Here impairment loss generally will not exceed 240. There might be exceptions, but generally it will not exceed 240. Stage 2 is only for goodwill impairment, as CGU A and B has already been impaired. All the assets of cash generating unit A as well as B has already been impaired. So what is the stage 2 impairment that we are doing? Only for goodwill. Therefore I'm telling you, this impairment loss, whatever you'll get, generally will not cross the goodwill value. Got it? All right, fantastic. That's it. Okay, sir. Now we are done with goodwill as well. What is the next thing we have got? Corporate assets. Now let's come to this content which you have missed earlier. Ready? Yeah? What did we miss earlier? Why goodwill on corporate assets are tested only at CGU level? Why? Because they don't generate independent cash flows on their own. Just like how an individual asset or a machine, if they are not capable of generating independent cash flows on their own, we're going to test them at CGU level. Same logic applies here as well. When goodwill and corporate assets are not capable of generating independent cash flows on their own, they are also tested at CGU level for impairment, as simple as that. So goodwill and corporate assets, example for corporate asset is head office building. I also gave you another example, that IT infrastructure. Anyways, cannot be tested individually because they do not generate independent cash flows. Instead, they contribute to the cash flows of other assets, so their impairment assessment is done at CGU level. That's the point. Now, we are already done with goodwill. Now, the only thing that is left over for us is corporate assets. So let's go with corporate assets allocation right now. Now look at this, Nana. Corporate assets. Now we know that corporate assets like head office building, okay, or research unit, or even I was talking about IT infrastructure, these, they do not generate independent cash flows on their own. Therefore, you cannot do impairment testing individually for corporate assets, just like goodwill, just like certain assets or machines which cannot generate independent cash flows on their own. So therefore, they has to be part and parcel of CGU, and that's how we do impairment testing. So individual cash flows are not realized, so no VIU. If there are no cash flows, you cannot calculate value in use, and hence no individual impairment test. That's why corporate assets or goodwill or certain machines or PPE which cannot generate independent cash flows on their own are actually done for impairment testing as part and parcel of CGU. Got it? Now, when it comes to corporate assets, there are two cases similar to goodwill. In goodwill also we have seen allocable goodwill, unallocable goodwill. Exactly the same over here. When it comes to the so-called corporate assets also, we have allocable as well as unallocable. Just a second. Okay. Sorry for that. So allocable means, yes, you can distribute it. So here also, similar to the goodwill, we have two parts. The benefit that is being provided by the corporate asset is given to only one single CGU. In that case, what you should do? If the benefit is given to multiple CGUs, then what you should do? Right, it's the same stuff, Nana. When it comes to allocation of impairment loss, you will do it in the ratio of carrying amount of all assets, including corporate assets. See, when it comes to goodwill, what did we see? In case of goodwill, for the same scenario where the goodwill benefit is given to single CGU, what did we see? First, the impairment loss will be allocated entirely to the goodwill. After that, still if any impairment loss is left over, that will be allocated to remaining assets in the ratio of their carrying amounts. Correct? Same stuff here also. It is a continuation of that. First, you will allocate to the goodwill. If there is goodwill, then whatever balance is left over, that impairment loss, whatever the balance that is left over after allocation to the goodwill, will be allocated to the remaining PPE or remaining assets in that CGU in the ratio of their carrying amount, including corporate assets. in the ratio of carrying amount of all assets, including what? Corporate assets. So which means we are not learning something new over here. Okay, fine. First, I'll start with impairment loss. First, I'll calculate by comparing carrying amount of the CGU with recoverable amount of the CGU. Then I'll take that impairment loss. I'll check for any goodwill. Completely, it will be given to the goodwill. After giving to the goodwill, if something is left over, then I'll see what all other assets are left over in that particular CGU, which includes corporate assets. In that carrying amount ratio, the impairment loss will be allocated. Simple. What about if benefit is being given by the corporate asset for more than one CGU? Very simple, ratio will be given in the question. So allocate corporate assets to CGU in the ratio given. Once you have allocated it, again the treatment is the same. You check the impairment loss. First it will be given to the goodwill, and the balance impairment loss will be given to all the remaining assets, which includes corporate assets, in the ratio of what? Carrying amount. Simple. Got it? Unallocable corporate assets is the same stuff. Benefit to CGUs but cannot be allocated. Same as unallocable goodwill, which means what you should do? First presume as if there is no corporate asset. Just like how we did presume that there is no goodwill. And after that, do all the impairment testing for all the CGUs. Then after that, CGU1, one column, CGU2, another column. Goodwill, we took another column. Na? In the place of goodwill, corporate asset will come. Or if goodwill is already there, then goodwill one column, corporate asset another column. And then we'll do impairment testing. You understand the point? The same way how we did impairment testing for unallocable goodwill, similar way we'll do it for corporate asset as well. Only thing is that in the earlier example, we had CGU1, one column, CGU2, another column. Then what? Goodwill, another column. Now corporate asset, another column will come. That's all. Clear? You will have much more clarity once I'm done with examples. Okay. Now that I've just given you a basic idea of the concepts, let's go with the examples. First example is what? Corporate assets benefit to single CGU. Okay. Benefit to single CGU. That is CGU A in our earlier example. Correct? Same stuff will be going. Now see. We have camera in CGU A, laptop, mic. Okay. 3 assets. In addition to that, we have got corporate asset. Clear? Carrying amount 1600. Recoverable amount 1280. Is there impairment loss? Yes. First, this will be allocated to what? Goodwill. But do we have goodwill over here? Goodwill, goodwill, goodwill? No. Therefore, there is no goodwill. Now what we'll do? Allocate this to all these 4 assets in the ratio of what? Carrying amount. What is the ratio of carrying amount? 4:8:2:2. Or in other words, 2:4:1:1. That's what. In that ratio, it is allocated. 2:4:1:1. Done. Okay. Now let's go for another CGU. That is B. Projector, iPad, furniture. Okay. Total 1800. All right. Recoverable amount 2200. You understand the point? Do we have any impairment loss over here? Nothing, because your recoverable amount is greater than carrying amount. That's all. Okay. So this example is about benefit to single CGU. That's why in CGU A you have corporate asset. In CGU B there is no corporate asset. Why? Because there is no benefit from the corporate asset to CGU B. That is the reason I did not take. Whereas CGU A has got so much of benefit from corporate asset, therefore it has been included. Clear? Now, in the second case, benefit of the corporate asset is being enjoyed by multiple CGUs. That is CGU A as well as CGU B. In this case, what you have to do, ratio will be given in the question. What is the ratio? 2:3. 2:3 means what is the total corporate asset value? 200. This will be allocated to CGU A as well as CGU B in the ratio of 2:3. That is nothing but 2/5 and 3/5. You multiply with that. Now the corporate asset allocated to A is 80. Allocated to B is 120. So in A you'll have 80. In B you'll have 120. That's all. Okay. Now what you'll do as usual, total it up. Total the carrying amount. What is the total carrying amount? 1480. What is the total recoverable amount? 1258. Is there any impairment loss? Yes. Do you have any goodwill? No. Which means the entire impairment loss will be allocated to all these 4 assets in this CGUA in the ratio of carrying amount. What is the carrying amount ratio? Have 20:40:10:4. That's it. If you divide this, that's what you're going to have now. 400:800:200:80. You do that allocation. Here I've given the ratio. Then you'll have impairment loss allocated to all these assets. You reduce that, you'll be getting your revised carrying amount. Simple. Okay. What about CGUB? In that also corporate asset is 120. What is the total of carrying amount? 1920 of CGUB. What is the recoverable amount? More than carrying amount of CGUB. Therefore, there is no impairment loss. That's it. Let's go to example 3. Unallocable corporate assets. What about unallocable corporate assets? First, you start doing impairment testing for all these CGUs, presuming that there is no corporate asset. Got it? Let's start with CGA. So what is the thought process I should go for? There is no corporate asset. Therefore, the column into F put over here. Okay. Camera, laptop, mic. Total of this carrying amount is 1400. Compare that with recoverable amount of CGUA. Do we have any impairment loss over here? Yes. How much is the impairment loss, Nana? I missed it over here. 1400 and 1260. 140, na? 140 is the impairment loss. Now, I don't have any corporate asset over here. I don't have any goodwill as well, right? Goodwill is not there. Corporate asset is there, but I presume that it does not exist because of unallocable nature of corporate asset. Therefore, what I'm doing, I'm taking this 140, giving it to these three assets in the ratio of their carrying amount, which is nothing but 4:8:2. In other words, 2:4:1. In that ratio, impairment loss is allocated, and then you reduce that to get revised carrying amount. Okay, 400 minus 40, 800 minus 80, 200 minus 20. Fantastic. CGUB. Here also you have to do the same way. You presume that corporate asset does not exist because it is unallocable. Then you compare carrying amount total of CGUB with recoverable amount of CGUB. And your recoverable amount of CGUB is greater than what? Carrying amount. Therefore, there is no impairment loss. Done and dusted. Now, individually, did I test CGUA as well as CGUB for impairment testing? Yes. Now, CGUA will become one column. CGUB will become another column. Corporate asset will become another column. So, combine CGUA and CGUB. If there is C also, that also will be combined. And corporate asset. So, CGUA, these many assets put together. CGUB, these many assets put together. Already impairment testing is done. So, therefore, for CGUA, after impairment testing, the value is 1260. CGUB, after impairment testing, the value is 1800. So, take 1260 as well as 1800. And corporate asset, which is non-allocable, therefore, it comes here, which is 240. Total of this carrying amount is 3300. What is that? All the CGUs, including corporate assets, put together. So, now, what is the recoverable amount? It will be given in the question, 3100. Do you have impairment loss? Yes. How much is that? 200. Now, this 200, what? Will I apportion it again to CGA, CGB? No, because CGUA and CGUB already impairment testing is done. So just like unallocable goodwill scenario, whatever the impairment loss that you get here will go only to corporate asset. What is the impairment loss? 200. What is the corporate asset? 240. Reduce the 200, you get your 40. Job done. So entirely this impairment loss will be given to corporate assets. Clear? Everybody? Fantastic. That's it. We'll be doing these sums, don't worry. Chalo. Are we done with this? Okay. So that is the concept that I've told here. Allocation of goodwill and corporate assets to multiple CGUs for impairment testing. Step 1. Allocate goodwill and corporate assets to multiple CGUs based on the ratio provided in the question. Okay. This is nothing but we are talking about allocable goodwill or allocable corporate assets where the benefit is enjoyed by multiple CGUs. In that case, if the question specifies allocation on pro rata basis, normally if the ratio is given, you copy paste that from the question. If ratio is not given, but question tells you something else, what is that something else? Question says, allocate the so-called goodwill as well as corporate assets on pro rata basis to the CGUs. And in that case, what you will do, take the carrying amount of other assets in CGU and multiply that with useful life of CGU. Sir, what is this, sir? We will see that. We'll solve a sum so that you'll understand. Don't worry about that. But this is a new way of allocation. As I've written here, question number 23 will be solving based on that only. Next, any unallocable goodwill or corporate asset will be subject to different impairment treatment. That we will see later. Now, the biggest question that you will have right now is, sir, whatever the examples that we have done so far, we have allocated the goodwill and corporate assets to multiple CGUs in the ratio provided in the question, sir. For example, if you see here, the ratio of 2:3 is given in the question. Earlier in the goodwill scenario also, it was given in the question. So this point is very clear, sir, because we have already done it in the example, right? Sir, what about this point, sir? This is a little bit not so comfortable for us. If the question specifies allocation on pro rata basis, what is this pro rata, sir? You are saying that allocate to multiple CGUs, which one? Goodwill and corporate assets, in the ratio of, not the ratio that will be given in the question, but instead carrying amount of other assets. Other assets means other than goodwill and corporate assets, and multiply that with useful life of CGU, you will get a ratio. In that ratio, you have to allocate goodwill as well as corporate assets. Or what is this, sir? If we can have a sum, it will give us clarity. Let's do that. All right, Nana. We'll be going for this sum to get better clarity. But before that, let me give you a logic. Try to understand whatever that is possible for you. Okay. So, allocating goodwill as well as corporate assets, if you could remember, initially I was using the word the amount of benefit that is being given by the goodwill or corporate asset to a particular CGU. In that ratio, you will try to allocate. Now the question is, if there are multiple CGUs like CGU1, CGU2 and CGU, how much benefit did they enjoy from the corporate asset is the biggest question. How do you calculate that benefit? If that is given in the question, then you'll just copy paste that ratio. In that ratio, you'll allocate the goodwill to multiple CGUs or corporate assets to multiple CGUs. वो तो simple है, because it is given in the question, you just copy paste that. If it is not given in the question, then what your Ind AS is saying is that you take the carrying amount of other assets and then you multiply that with useful life of the CGU. What is the reason behind that? The logic is very simple. Why he is asking you to take carrying amount of the other assets? Because carrying amount talks about the base value of the asset. Suppose one asset has got 100 lakhs of carrying amount, another asset has got 200 lakhs of carrying amount. Naturally, when compared to 100 lakhs asset, 200 lakhs asset will get more benefit from goodwill or corporate assets. That is one logic. The second logic is greater the life, because he is asking you to multiply with useful life now. So more the useful life, more will be the benefit that you enjoy. Suppose useful life of a particular asset in a CGU is 5 years, Nana. Another asset is 10 years, Nana. Naturally, 10 years asset will get more goodwill benefit. 10 years asset will get more head office benefit or corporate asset benefit. Are you able to understand? So more the life, more will be the benefit. Now, therefore, based on that, you divide it. That's how the ratio has to be calculated. So I gave you the logic here as well. A CGU with bigger asset base, that is nothing but carrying amount of other assets, and longer benefit period, that is nothing but useful life of the CGU, is assumed to consume or support more of the corporate asset or goodwill benefits. Is assumed to take more benefits, therefore more proportion of that goodwill or corporate asset will be given. Got the point? I hope you are getting the logic. Still, if you don't get the logic, don't worry. Anyway, we'll be solving question number 23. So therefore, the allocation tries to match benefit consumption with the CGU. Therefore, for CGU, how to calculate impairment loss? Very simple. Carrying amount of the CGU will be compared with recoverable amount. As simple as that. Okay. Now, let's go for this problem, Nana. Question number 23. It's very important question, and that's why we are solving. Okay. ABC Limited has 3 cash generating units A, B, and C. The carrying amounts of which as on 31st March 20x1 are as follows. You've got 3 cash generating units, carrying amount is given, remaining useful life is also given. Correct? I hope everything is fine. So ABC Limited also has 2 corporate assets having a remaining useful life of 20 years. X, Y, carrying amount is given. Remarks: the carrying amount of X can be allocated on a reasonable basis, that is pro rata basis, to the individual cash generating unit. The carrying amount of Y cannot be allocated on a reasonable basis to the individual cash generating units. Allocable. This is unallocable. We are talking about corporate assets. Okay, recoverable amount as on 31st March 20x1 is as follows. Recoverable amount is also given for all the 3 CGUs as well as for the company as a whole, ABC Limited. Got it? Chalo. Calculate impairment loss, if any, ignore decimals. That's all. That's the question. Pretty easy. We already know what to do, so let's do it. Question number 23, let's solve. So, question number. Now, tell me one thing, Nana. If you want to allocate allocation of corporate asset X, why I'm talking about corporate asset X? Because the other corporate asset, anyway, it can't be allocated, na? Y, anyway, it cannot be allocated. So, Y is unallocable. Unallocable corporate asset. X is only allocable. So, let's talk about X only right now. Okay. In what way you need to allocate? Pro rata basis. What is pro rata basis? Carrying amount into full life. Correct? That's what we have learned right now. We have seen the logic as well. So we are not by hearting anything, right? I hope when I say the logic, you guys are enjoying as well. So let's go for the allocation. So first what we need to do is that, let me write, okay, NCG and carrying amount from the question, 500 for A, 750 for B, 700 for C. Correct? Now, what is the pro rata basis? Carrying amount into useful life. Next, I need use. that I can multiply both and I can find the ratio. Useful life is 10, 20. All these things you just need to copy paste from the question, Anna. 10, 20, 20, 500, 750 and 1100. That's what I've done over here. So it is there in the question, I just copy pasted, that's all. Now let's multiply. Let's say this is A. I need A into, so 500 into 10, 5000. 750 into 20, how much, Nana? 15,000. It's 1100 into 20,000. What is the ratio that I'll be getting from this? I have 3 zeros common, huh? So 5 is to 15 is, remove those 3 zeros. That's it. Now let's allocate the corporate assets. So allocation of corporate asset, okay, X amounting to, this is the value of that corporate asset, 600. Huh? 600 only, na? You can see the question over here. So that 600 needs to be allocated. Easy, easy. So 600 into 5 divided by, what is the total of this? Total of this, sorry, 42. 42 is the total. So into 5 by 42. Next here, 600 into 15 by 42. Here, 600 in 22 by 42. Tell me how much are those numbers? 71, 14, 315. Huh? Done. So you're done with the allocation. Now, once you have allocated the allocable corporate asset to all the CGUs, next step is to go for impairment testing. Let's go for impairment. Impairment testing, first we'll go for stage 1. You can call it a stage 1 or step 1. Okay, what is stage 1? Individual CGUs. Okay, with corporate asset X. But this is important. Without corporate asset Y. Correct? Huh? Did you forget Y? What is the logic? Recollect the concept. If there is allocable corporate asset, we will allocate it to all the CGUs, and then accordingly we'll be what? Allocating them. As simple as that, right? If there is unallocable corporate asset, then we will do individual impairment testing for CGUs. We'll do it as if there is no corporate asset. If it is unallocable, right now we'll presume that there is no Y. There is no corporate asset called Y. So we will do individual impairment testing for A, B and C. After that, at last, A will be one column, CGU B will be another column, CGU C will be another column, corporate asset will be another column. Which corporate asset? Unallocable corporate asset. What is that unallocable corporate asset? Y. Y only, na? Huh. Y at last. At last step we'll have Y. Then we'll do impairment testing for the company as a whole. Are you able to get me? Then, but for X, that is not required. For corporate asset X, anyway it can be allocated. Therefore, we'll be doing right now itself. Are you able to understand? So all the things are falling place all of a sudden. So you should be able to be, Okay, anyways. Now, let's start with first CGU A. So you have other assets, have corporate asset X, having total column. So first I'll start with carrying amount. What is the other assets carrying amount of CG? 500. Because anyway, individually it has not been given, Anana. All the assets put together, it is 500. Therefore, I have written the heading other assets. He did not give you in other assets, mic is so much, or camera is so much, or laptop is so much, or iPad is so much. Like that, he did not give you. Okay. Corporate asset X, how much is the allocation to A? You already know that. For A, how much is allocated? 71. Right. Sir, corporate asset Y is also there, na sir. That's what Y is unallocable. Therefore, we go with the presumption that Y does not exist. At last, we'll see. At last, we'll see. Okay. Now, tell me what is the total of the carrying amount? 571 for CGU A. Okay. What is the recoverable amount? 600. Now, tell me if recoverable amount is greater than the carrying amount, is there any impairment loss? No. Therefore, will I do any impairment loss allocation? No. Next, go to CG. Again, same columns. Other assets, corporate asset. Then you have now carrying amount 750 given in the question. How much is the allocation for B? 2. Total 9. Recoverable amount given in the question 900. Is there impairment loss? Yes. 6. This will be allocated to other assets and corporate asset in the ratio of their carrying amount. So which means allocation in the ratio of carrying amount. So impairment loss in the ratio of carrying amount means what is the total impairment loss? 64 into 750 divided by total carrying amount 750 plus 214, which is 960. Here it will be 64 into 214 divided by 960. Simple. Tell me how much of the number impairment loss? This 14. You reduce that, you will be getting revised carrying amount. So revised carrying amount equal to 750 minus 50. 700. 214 minus 14. How much? Are we done with this? All right. CGUC. We've got other debt. X. We have carrying amount 315 only, na? The allocation of corporate asset X for CG 31. 700 is copy paste from. What is the total? 1450. Recoverable amount 1400. Is there any impairment loss? Yes, 15. That will be in the ratio of carrying amount. So impairment loss 15 into 700 is the carrying amount of other assets divided by total carrying amount. Here 15 into 315 divided by 1450. How much you get? Walla. X. We reduce that, you'll be getting revised carrying amount. Correct? Okay, revised carrying amount 1088. So stage 1 is done, where you have done individual testing of CGU A, CGU B, and CGU C. Now what is the next one? Stage 2. Why we need to go for stage 2? Basically because there is unallocable corporate asset. Suppose there is no unallocable corporate asset, there is no unallocable goodwill, there is no need of stage 2. In stage 1 itself it is done, because stage 1 itself all the allocation stuff is already done. Na? Any goodwill or any corporate asset, if it is allocable, it will be done in stage A itself. Stage B question will arise only if there is unallocable goodwill or unallocable corporate asset. I hope this is clear, right? Now, so stage 2, combined impairment test. Combined impairment test. It is nothing but CG A plus B plus C plus corporate asset Y. CGU A plus B plus C plus corporate asset Y. Okay. Now, CGU A, one column, CGU B, another column, CGU C, another column, corporate asset Y, which is unallocable corporate asset, another column, then total column as well. Got it? First, carrying amount 571, na? CGA, which is already impairment testing is done. 571 here, here 900, here 1400. No. When there is impairment, you should take recoverable amount 1400, 900. Here there is no impairment, therefore I'll take carrying amount, which is 571. So 571, 900, 1400. Corporate asset Y is how much? 100. That is unallocable. So 200 will come here. What is the total? 3071. What is the recoverable amount for the entire company? That is also given in the question. ABC Limited recoverable amount 3200. Compare with that 3200. Now recoverable amount of the entire ABC Limited is greater than carrying amount. Therefore, there is no impairment loss over here. Therefore, you will not be doing anything. That's all. Impairment loss will be nil. Got the point? See? Easy. Once you start doing sum, automatically it will become easy, Nana. So if the concepts has to become easy, we have to start solving sums. Without solving sums, concepts will not become easy, or any sort of doubt that this will be there, na, that will get clarified only when once we start what? Solving problems. I hope this problem solving should have given you much more clarity. So which means we're done with this. Any unallocable goodwill or corporate asset will be subject to different impairment treatment. That is nothing but stage 2, what we have done right now. Are we done with this? Finished? All right, Nana. So we are done with this. We are done with question number 23 as well. Now, how to calculate carrying amount of CGU? Very easy. Any PP is there, uska carrying amount, you take it as per Ind AS 16. Carrying amount of intangible asset as per Ind AS 38, you take that. I mean, I'm talking about different assets inside the CG. It can be tangible asset, it can be intangible asset. Okay. It can be current asset as well. Sir, current assets means this is where people get confused. Sir, current assets means first of all, inventory is not covered. Trade receivables is not covered because inventory is covered as per Ind AS 2. Trade receivables and all those things is covered as per what? It's a financial asset, na, as per financial instruments. So that is not covered here, Nana. Other intangible assets will be covered. Got it? All right, Nana. Last session it was cut over here, but that's okay. Let's continue. So what I was talking about is that with respect to current assets in CGU. Now, first one is very easy. Carrying amount as per Ind AS 16, whatever the PPE value is there, that you will put it over here. Carrying amount of intangible assets in CGU as per 38, that value you will put it over here. Carrying amount of current assets in CGU, this is where I think some of the faculties also they're getting confused. Well, the point is, unfortunately, normally when I talk about current assets, immediately what will come to my mind? Inventory as well as trade receivable. Now the question is, these inventory and trade receivables, should they be included in the carrying amount of current assets in CGU? The answer is yes as well as no. Sir, what is that you are trying to say? What do you mean by yes? What do you mean by no? The logic is very simple. See, how do you calculate your impairment? Sir, I'll compare carrying amount of CGU, sir. I'll be comparing that with recoverable amount of CGU. That's how you calculate your impairment now. This recoverable amount is given in the question, right? Now, what you need to ask yourself is, while calculating this recoverable amount of CGU, listen very carefully, this is very important, where majority of the students and faculty getting confused. Recoverable amount of the CGU, when this has been calculated, did you take into consideration the cash flows of certain current assets like inventory as well as trade receivables? Did you take into consideration? If the answer is yes, the inventory and trade receivables, uska cash flows be considered hua when you are calculating recoverable amount of CGU. In that case, in carrying amount of CGU calculation also, this inventory and trade receivables will be included, like a matching concept and consistency. So while calculating recoverable amount, if cash flows related to these things have been included, then while calculating carrying amount of CG also, when I say current assets, inventory and trade receivables will be included. That clarity you need to have. Suppose in recoverable amount calculation, if the cash flows with respect to these current assets which are dealt by separate Ind AS, if they are not included, then here also it should not be included. It's as simple as that. Am I clear, everybody? I hope this confusion is gone. So hereafter, don't get confused with respect to what? The so-called current assets when it comes to CG calculation. Okay. The rest of the things are very simple. Goodwill allocated will be considered. Corporate assets allocated will be considered. If they are not allocated, then we know how to solve it. We have already seen examples, right? At last, we'll do CGU1 one column, CGU2 another column, and then goodwill, which is unallocated, one column, corporate assets unallocated, one column. Then you'll total up the entire carrying amount of all the CGUs put together. You'll compare with the carrying recoverable amount of the company itself, and then you'll go for testing for impairment, and that effect will be shown only in unallocable goodwill or unallocable, the so-called corporate assets. You will not be touching the CGUs because CGUs are already impaired. This we have already seen in the form of examples, right? So how to calculate carrying amount of CGU? It's very easy. Nana, you will start with PP as per Ind AS 16 carrying amount, then intangible assets as per Ind AS 38. Then comes the most, confusing part, that is current assets. I gave you the logic over there. Normally, other than inventory, trade receivables, all these current assets will be considered. Inventory and trade receivables will be considered, provided while calculating the recoverable amount, the cash flows relating to the so-called inventory and trade receivables have been considered. In that case, in carrying amount calculation also, we will consider, so that there is consistency in, comparing. Comparison consistency must be there, na? In recoverable amount, you have considered. Then in CGU of carrying amount, if I don't consider, means then the impairment calculation will go wrong. So if you have considered in recoverable amount, I will also consider that in carrying amount. That is how the logic goes. Okay. After that, allocated goodwill as well as allocated corporate assets. So pretty easy to remember, right? Are we done with this? Next. Order of allocation of impairment loss to assets in CGU. This also we have already seen. What is the order? First, we'll go for goodwill. Then to the extent of goodwill, everything will be reduced. Balance will be gone in the ratio of what? Carrying amount, or the other ratio also we have seen, where carrying amount will be multiplied with number of years. See here. Remaining loss, that is impairment loss, after setting off the goodwill, is allocated to other assets, including corporate assets, on pro rata basis in the ratio of their carrying amount, except those outside the scope of Ind AS 36, which is nothing but trade receivables, investments, as well as inventory. Got the point? Problem also we have done based on this, based on pro rata basis. Correct? Chalo. Pro rata logic also I've explained you why we should be taking carrying amount and then we should be multiplying with the life of the asset, right? If multiple assets together generate CGU's cash flows, then the pain of impairment shared in proportion to their book values, unless the asset is outside the scope of Ind AS 36. Here you can add not only book value and life of the asset as well. That point is missed over here. Life of the asset as well. That anyway we have solved it. I mean, we have seen it in the question over here. Carrying amount of other assets, which is nothing but book value, into useful life of the CGU as well. Right, that is what the point is over here. Right, are we done? Okay, Nana, let's continue. So this is not something new that we have seen already over here. And question number 23 also we have solved. So nothing new over here. Next. This is interesting, see, Nana. There are some important notes with respect to what? The so-called allocation of impairment. Now see here. First point. If any asset is tested individually, and the same asset also forms part of the group, which is nothing but CGU, then no impairment loss will be allocated to that asset in CGU. First of all, let's try to recollect something that we have already discussed. When asset will form part of CGU, Nana, say for example, there is an asset called machine 3. This machine 3 cannot generate independent cash flows. That is not possible. When it cannot generate independent cash flows, I cannot find present value of the cash flows, which means I cannot find what? VIU, which means eventually I cannot calculate recoverable amount, which means I cannot do impairment testing, correct? Therefore, this M3 will be included in CGU, which is part and parcel of like group of machines which can generate independent cash flows. That is the logic. Now, suppose there is something called M8, another machine, okay? This can generate cash flows. It can. If it can generate cash flows, then CGU question itself will not arise. Here itself, you will do impairment testing. Like that, there is a mission. Now what you're doing, M8 mission, already impairment testing is done because independently it is capable of generating cash flows. Then again, you're taking that M8 and in this, let's say this is CGO X. In this CGO X, M8 is also included. Let's say there are 8 missions in CGO X. You understand the point? In this cash generating unit with a name called X, 8 missions are there. In that 8th mission, already it has been tested individually because it generates cash flows independently. Now, rest of the missions, let's say they are not generating cash flows independently. You understand the point? So therefore, they are forming part of a CGU. Then again, for this mission, you will not be allocating nana. Then you would have been doing impairment testing twice. So which is not correct. That's what we are trying to say over here. If any asset is tested individually and the same asset is also included in CGU, then no impairment loss will be allocated to that particular asset in CGU because its individual impairment test is already conducted, which means double counting you should not do. That's all. Here, a building is tested individually because it has its own independent cash flows via rentals and is also part of a CGU. It's already written down individually, then CGU impairment allocation should not hit it again. Then double impairment testing will be done, which is not correct. Then you're undervaluing that particular asset. Okay, this is one important point. Keep that in mind. Next, point number 2. A CGU does not include any liability, But a liability may be included if the recoverable amount of CGU cannot be determined without considering such liability. Sir, what is that, sir? What is the basic rule? Liability should be included or not included in CGU calculation? Should not be included. This is a basic rule. First, you remember that. Okay, see, in CGU will not include any liability, because did we include any liability over here? No, we're talking about assets only, right? Okay. But a liability can be included. There is an exception. So the general rule is liability should not be included while calculating CGU. That's fine. Okay, when can you include a liability? Very simple. If the recoverable amount calculation of CGU cannot be done unless that liability is included. The recoverable amount calculation means what basically? FELCTS or VIU, whichever is higher. FELCTS though, it's just copy paste number. VIU means present value of future cash flows. In that present value of future cash flows only, liability also should be included in that cash flows. Then only the logic works, right? What can be that liability? Very simple. Decommissioning. Decommissioning is a liability only, na? While calculating the cash flows of the asset, in future you have to do decommissioning after 10 years or after 15 years, and that is a liability, right? And without including that liability, can you calculate present value of cash flows for that particular asset? No. Without calculating present value of cash flows, can you calculate value in use, which is nothing but VIU? No. In that case, that liability also shall be included in CGU calculation here. But a liability may be included if the recoverable amount of CGU cannot be determined without considering such liability. Example, provision for decommissioning or restoration. Simple, that's all. So the logic is normally CGU means assets only. That is the general rule. No liability, but there is an exception. Next, unallocated goodwill or corporate assets. This we already know, 2 stages. First, what you will do, individual CGUs will be tested. And finally, all the CGUs for which impairment is already tested, then unallocable goodwill one column, unallocable corporate assets another column, and then you will total the carrying amount. You will compare with the recoverable amount of the entire company, and then you will be doing impairment testing, where whatever the impairment is there, that will go to only the goodwill. After that, corporate assets, that's all. It will not go to CGUs because they have been tested for impairment already. That is what is the treatment for unallocable goodwill as well as what? Corporate assets, which we already know. Stage 1, stage 2. First, conduct impairment test of all individual CGUs without goodwill or corporate assets. What goodwill or corporate assets? Not allocable goodwill, unallocable goodwill or unallocable corporate assets. This we have already seen. Then conduct impairment test of the group CGU with goodwill or corporate assets. This we already know. Next. So this is the format. This also we have done. In fact, we have solved a problem as well, correct? Chalo. Now come to the next concept. What is the next concept? Goodwill acquired in business combination. Now this is important, Nana. So listen carefully. This is another area. I told you one area where students get confused. That is nothing but current assets inclusion when it comes to CGU. Okay. Another area where they get confused is this one. Goodwill acquired in business combination. So listen carefully. Listen carefully. Alright, Nana. You guys are ready? Okay. Now focus. Now after this, there is only one concept is left over, that is reversal of impairment. That's all. We'll be done with this entire Ind AS. Now, very important, listen, Nana. When it comes to goodwill acquired in business combination, okay, I'm talking about partial goodwill over here. Okay, before we get to partial goodwill, let's try to understand. When it comes to Ind AS 103, what did we do? Sir, what is there, sir? When it comes to accounting for business combination, every single entity, they've got 2 choices, correct? Choices. I'm using the word choices. Okay, when it comes to measuring NCI, they can either go for full goodwill method, or they can go for partial goodwill method. Correct? Full goodwill method is nothing but fair value method. All of you guys are aware of this. And partial goodwill method is nothing but PASNA method, proportionate share of net assets. Okay. Now, suppose goodwill is recognized during business combination by measuring NCI at fair value method. That is nothing but we call it as full goodwill method. Okay. If this is the case that has already happened, where you have gone for business combination and your goodwill is recognized, in that scenario, your NCI has been valued at fair value method. That is nothing but full goodwill method, which means whatever goodwill that you have recognized, in that NCI ka share is also there. Not only parent share, but NCI ka share is also there. For example, let's say goodwill is 100, Nana. Parent share is 80%, NCI share is 20%. Okay. If the way you have recognized goodwill is by following fair value method or full goodwill method, then whatever the goodwill that you have recognized in your books, in that both parent share will be there as well as NCI ka share also will be there. You understand the point? That's why it is called as full goodwill. You should remember 103. If you don't remember 103, unfortunately, we can't do anything. Okay. So in this case, there is no problem when it comes to impairment testing. There is no adjustment needed. Nothing is needed. So when you are doing impairment testing, and in that scenario, whatever the goodwill for which you are doing impairment testing has been full goodwill, no problem whatsoever, no confusion whatsoever. All the problem and confusion will come only when there is PASNA method, or you can also call it as partial goodwill. If this is there, then all the problem comes. Sir, what kind of problem comes, sir? So this is where you should not get confused. So listen carefully. Everybody, respond, Ray. Okay. Now listen carefully. Now see here. When it comes to PASNA method, what is PASNA? Partial goodwill. Partial goodwill means what? Whatever the goodwill amount that you see in your books belongs to only parent. Belongs to only parent. So which means parent ka goodwill sirf recognize ho gaya hai books mein. Then what about the so-called NCI ka goodwill? NCI ka goodwill is not recognized. NCI ka goodwill is not recognized in books. Clear? Now, because of this, what Ind AS 36 says is that when you're going for impairment test, how do you do your impairment testing? Sir, what is there, sir? I take the carrying amount and I compare that with recoverable amount. Correct? Let's say we are talking about CGU over here. Okay, carrying amount of CGU, recoverable amount of CGU. Okay. Now, when you are comparing these two, in this carrying amount of CGU, there will be goodwill. And Ind AS 36 says this goodwill should be full goodwill only. But in case if you followed this method, then there is no problem. It should be full goodwill. It is full goodwill, so there is no problem. But in case if you followed partial goodwill method, then here full goodwill is not there. Na? If full goodwill is not there, in a way, the carrying amount is understated. Then in that case, if you are comparing with recoverable amount, then whatever the difference, which we call it as impairment loss, this will also be wrong. Na? Are you able to understand what I'm trying to say? If it is not full goodwill and it is partial goodwill, then whatever the goodwill that is inside the CGU, it is less than what it should be. It is less than what it should be. So in that case, if when you are comparing with recoverable amount, the carrying amount, and then if you are calculating impairment loss, then that impairment loss also will be wrong. Are you able to understand? Therefore, what Ind AS 36 says is that it uses the word gross up. The official term is gross up requirement, which means make the so-called partial goodwill full goodwill. Make the so-called partial goodwill full goodwill. Sir, how to do that, sir? For that only, we'll be doing a problem. Now, once I do a simple, not a problem, example. Once I do this example, you'll get 100% clarity. So, listen carefully. Ready? Small example only, Nana. Now, see here. Let's say parent owns 80%. NCI ka share, obviously 20%. Correct? Okay. Goodwill recognized, obviously PASNA method. PASNA means partial goodwill. Let's say it is 80. Okay. Then NCI ka goodwill value will be how much? 20, na, naturally. Parent share is 80%, na. For 80%, if the goodwill is 80, then for 20%, it has to be 20 naturally. Correct? Hello? Nana, this is not real goodwill, Nana. Let me write the word notional goodwill. So artificially, we are notching it up. Because Ind AS 36 says if there is partial goodwill, then you try to make it full goodwill by grossing up. Grossing up means you increase the value. So now what has been recorded in your books is only 80. This is only recorded. Recorded in books. Because you have followed PASNA method. As per PASNA method, partial goodwill is only calculated. And that is only recorded. So in your books, 80 is only there. Goodwill ka value is 80. But, while doing impairment testing, for the purpose of testing, you botch up the value. You gross up the value. You increase the value. You make it full goodwill. So if I make it full goodwill, it will be how much? 100. For what purpose? For impairment testing purpose. Nothing else. Impairment testing purpose only. Only for that purpose, you try to increase it. Now it became how much? 100. Clear? Now let's say suppose. Example only, na? So suppose carrying amount of CGU excluding goodwill is, say for example, 900. Now goodwill also should be added. What goodwill should be added? Full goodwill. How much is full goodwill? Will I add 80 or 100? 100 should be added. Even though 80 is recorded. Even though 80 is recorded in your books, because 103 gives you choice. Either you can go for full goodwill or partial goodwill. I went for partial goodwill. I recorded 80 only. That's my choice. Even though you have recorded 80, for the purpose of impairment loss calculation, when you are comparing carrying amount of CGU with recoverable amount of CGU, you increase the value of CGU. Why? Because partial goodwill is there inside. I don't want partial goodwill for comparison. I want full goodwill for comparison. So take the notional value of NCI goodwill and then increase your partial goodwill to full goodwill. So in a way, we have done from 80 to 100. Now that 100 will be added. So therefore, now carrying amount will be how much? 1000 only, na? Carrying amount of CGU for testing purpose. Testing purpose only. I'm stressing on this word. Only. Do you know the importance of the word only, right? Only for this purpose. So now I've made it 1000. So if I don't gross up the goodwill as per Ind AS 36, then it would have been 80. Then here it would have been 980. Then when you compare it with recoverable amount, definitely the difference will be higher and impairment loss will be more than what it should be. Got the point? Okay. Now carrying amount is done. Now this should be compared with what? Recoverable amount. Let's say recoverable amount of CGU is equal to, we'll say 940. In that case, impairment will be what? 60. Got the point? Impairment will be 60. Impairment loss. Now suppose here instead of 100, I would have taken 80. That is partial goodwill. Then this would have been 980. Then this would have been 40. Are you able to understand? Everybody. So carrying amount would have got reduced. Carrying amount would have got reduced means your impairment loss also would have got reduced. Na? Got the point? So now you're recognizing asli impairment loss. So it would have been 40 instead of 60. That's what I'm trying to make you understand. Chalo, now. Okay, sir. Now impairment loss ka calculation ho gaya. What is the next step? What is the next step means you'll allocate the impairment loss, na? Right? When you're allocating impairment loss and when there is goodwill, what is the order of allocation? First, it will go to goodwill. First, goodwill. First, goodwill will be reduced. Got the point? Sir, what is there, sir? First, goodwill will be reduced means our goodwill is 100, na, sir? From 100, I'll be reducing impairment loss of 60, sir. So the new goodwill is 40. Wrong. Wrong. Where is 100? 100 is only for testing purpose. In your books, there is no 100 goodwill. In your books, 80 only goodwill is there. Recorded in books. So which means the goodwill in reality in your books. Recorded. Kitna? 80. 100 is not there. Ah, okay, sir. 80 is there, na? Okay. I'll reduce 60, sir. Wrong again. Entire impairment loss should not be reduced. Why, sir? Sir, this I have understood. You said you should not take 100. Why? Because we have artificially bloated it to 100. In reality, what is recorded in the books is 80 only. Okay, I have taken 80. Logical, sir. Impairment loss is 60, na? Entire impairment loss, we try to set off with the goodwill, na? No. Only parent share. Only parent share. Because this 80, what has been recorded represents 100% goodwill or only parent share? Only parent share. So which means, can I say this 80 represents 80% because the parent share is 80% in our example? Then impairment loss also 80% only should be reduced. Okay. So which means out of 60, 80%. 80% into 60. Sir, which means 48, sir. 48 only will be reduced. Got the point? Only 48. Sir, then out of the total impairment loss of 60, 48 is gone here, sir. Then what about 12? 12 is NCI ka share. Because NCI ka share is 20%. Parents ka share is 80%. Okay, sir, what will do with this 20%? This is not recorded, na? Basically, it is not there in your books. this NCI ka goodwill has never been recognized in your books under partial goodwill method. So therefore, now comes the most important point. Listen carefully. Summary. This is where many people gets confused. Summary. You should gross up goodwill for testing of CGU so that the carrying amount of CGU is not undervalued. Only for testing purpose. That's why I've highlighted this. For testing purpose, you have grossed it up to 1000. Here goodwill should have been 80, but instead of that, you have increased it and it became 100 so that your carrying amount is 1000, so that when you compare it with 940, your impairment loss is 60. Otherwise, this instead of 1000, it would have been 980 and your impairment loss would have been 40, which is wrong. Only for testing purpose, we have increased it. Got the point? So gross up the goodwill for testing of CGU only. Okay. Whereas when it comes to recording of impairment testing, record only the impairment relating to recognized goodwill only. Record only the impairment relating to recognized goodwill. What is recognized goodwill? 80% only, na? Which is 80. So therefore, out of this impairment, 80% only should be recorded. 80% of 60 is how much? 48. Got the point? 12 will not be recorded because NCI goodwill was never recognized in books under partial goodwill method. Therefore, only parent share of 48 impairment loss will be recognized. If you want, I'll put the entry as well. That will give you clarity. So the entry will be impairment loss, debit 48. Goodwill will be reduced, na? Goodwill is an asset. To reduce it, you have to credit it, 48. That's all. Meaning after this entry, what's going to happen? Earlier, goodwill was 80 minus impairment, which is 48. Now the goodwill will be how much? 32. That's all. So for testing impairment, 100 goodwill will be taken. But for recording impairment, only 80 goodwill will be considered. And what you will be reducing the impairment is also parent share only will be reduced. This is very, very, very important, Anna. This is where many people get confused. I hope this is clear, everybody. Chalo. So let's look at the sentences over here. Under Ind AS 103, business combination, an entity has a choice between two methods, PASNA, which is partial goodwill, fair value, which is full goodwill. If NCI is measured using PASNA method, then the portion of goodwill relating to the NCI is unrecognized. Even though it is unrecognized in books, it is taken into account for the calculation of impairment loss. That is, gross up the carrying amount of goodwill to include what? Goodwill attributable to NCI. Don't give importance to this particular, the so-called what formula, because we know the logic. Right. Next. Don't by heart the formula. Guidance on allocation of impairment loss. The impairment loss is allocated between parent as well as NCI in proportion of their stake. That's why we have taken 80% of 60. In our example, impairment loss was 60, na? 80% will go to parent, 20% will go to NCI. If an impairment loss attributable to NCI, in our example, it was 12 out of 60, relates to goodwill that is not recognized. Correct only, na? This 12 belongs to NCI share of goodwill. NCI share of goodwill is not recognized. Then only impairment loss of parent's goodwill is recognized. That's why we have taken 80% of 60, and that 48 impairment loss is only recognized, and 48 was reduced by 80, and finally goodwill ka value is 32. So are you able to understand? So you will not understand this sentence otherwise. That is the reason I gave you this particular example. Clear? Done? Okay, chala, fantastic. Next, coming on to the last concept, Nana, reversal of impairment loss. Once we are done with this concept, ये तो हो गया. चलो. Let's go on with the last concept, Nana, reversal of impairment loss. Now here what we'll be doing is that we'll try to understand this with the help of example. But before we gonna go for the example, let's try to understand some important points. Okay, first important point. When I'm doing reversal of impairment loss, which means you're increasing the value of the CGU or individual asset, you will do that reversal except for goodwill. This is the first point you need to understand. Which means whatever the impairment loss that you have recognized in the earlier years can be reversed except for goodwill. Goodwill impairment, once it is recognized, it can never be reversed under any circumstances. Why? That is the biggest question. Well, already you have done the impairment for goodwill, which means goodwill is already gone. From your books, it is gone, right? After that, if there is an increase in the value of your CGU or whatever it is, recoverable amount increases, then probably it is internally generated goodwill. Correct? Are you able to understand? First, you cannot recognize internally generated goodwill. Second, externally bought goodwill you can recognize, and that with impairment it is gone. So therefore that external goodwill is gone. Now whatever the goodwill now you have got, it is internally generated goodwill, which cannot be recognized under Ind AS 38. Internally generated goodwill cannot be recognized under Ind AS 38. You got the point? So if I allow reversal of goodwill after impairment loss, then indirectly I'm allowing recognition of internally generated goodwill through backdoor. Do you understand? Everybody? That is the logic. That's why there is no reversal for goodwill impairment. Chalo. Once goodwill is impaired, done and dusted. That's all. Okay, next point. When you will go for impairment loss? See, it's exactly opposite to impairment. Impairment also I'll not do every year. Of course, there are certain exceptions, but general rule is only when there is an indication. Triggering point should be there. Similarly, for reversal also there will be certain indication. There also we have seen external indicators, internal indicators. Here also we have got external indicators as well as what? Internal indicators. Exactly opposite. It's like a mirror image. Exactly opposite to what we have seen for impairment indication. For impairment indication, whatever the points that we have seen, exactly opposite points we have for reversal of impairment loss. What about external indicators? Favorable effect on entity due to technological, market, economic or legal environment. Sir, what do you mean by this, sir? Earlier, whatever technological changes has affected you in a negative way, now it is affecting you in a positive way. Sir, what do you mean by that, sir? I'll give you a simple example. Simple example, not from the manufacturing point of view. I'll tell you one thing. I don't know how many of you guys are aware of cars. Okay. Once upon a time, let's say you have a car. Now, car is a depreciating asset. Everybody knows, correct? But then now you guys know that we are moving towards EV, correct? And which means all the big sized ICE engines, ICE means internally combustion engines, are going away. They're fading away. So let's say you have bought a car 10 years ago. It is a V10 engine, V12 engine or V8 engine. I'll not get into details of all these things. Now, obviously after 10 years, it should have got some sort of depreciations. Sure, solid amount of depreciation. But once all these engines are faded away and EVs have come into picture, now definitely all of a sudden the value for these cars have started increasing. Especially non-hybrid cars, pure naturally aspirated engines without any turbo, without any supercharger. If you have technical knowledge, you'll understand. Otherwise, just understand that sometimes technology, if it improves too much, then a non-technology car will have its value getting increased. You understand the point? So like that, there are certain situations where externally, because of certain factors, the nostalgic kind of items, uska value will increase. Now, if you see, there are people who are using phones without any screen. I don't know, I don't remember that brand name, but the phone cost is 10 lakhs. People are buying it. I think Vertigo. I don't know. Vertus? Something with V. Okay. Anyways. Asset market value has increased significantly. Market interest rate have decreased. Market interest rate have increased means cash flows will get affected negatively, and as a result impairment testing will be done. But market interest rate have decreased means your value will increase, na VIU will increase. So therefore reversal of impairment. So exactly opposite, Nana. Internal indicators, significant changes with favorable effect on the entity in the manner of usage of the asset. Sir, what do you mean by that? For example, previously there is an idle asset, Nana. It has been kept idle. Now all of a sudden, now it is brought back to active production. So it is an internal indicator. Now because you have got it to active production, uska value will increase naturally. So reversal of impairment loss. Because earlier you have kept it as an idle, probably you would have done impairment. Now reverse it. Economic performance of the asset will be better than expected. Sir, what do you mean by that? Suppose some internal MIS reports, management information system reports, now show that asset is outperforming its budget. Initially you would have estimated something, beyond that it is performing. So therefore you have to do reversal in case if you have already done impairment loss. Obviously reversal of impairment loss will happen only if and only if already impairment has been done. Otherwise, why would you do reversal when there is no impairment in the first place? Simple logic. So two important points we have covered. One, indicators of reversal of impairment loss, which is exactly opposite to the indicators of impairment, mirror image. Two, there will be no reversal of impairment when it comes to goodwill. That logic also I've told you, right? Fantastic. Now let's try to understand this with the help of example, because straight away if you go with these points, you will not understand, Anna. You'll get confused. All these points in a simple way I've covered in the form of an example. So let's look at the example. Now see, you guys are ready? Okay. I'll be going with two examples because when it comes to reversal of impairment loss, it can happen for individual asset as well as for CGU. Therefore, the first example will go for individual asset. Next example will go for CGU. Got it? With that, we'll be done with the entire Ind AS concepts, this particular 36. Of course, with few problems and a lot of examples also we have done. Examples are nothing but reverse engineering of problems of your ICA only, Nana. So, which means solid number of sums is also done indirectly, not directly. Now, this is also a problem, logically speaking. Now, see here. Reversal of impairment loss. Now, listen carefully. 1 for x1, cost of the asset is 1000, life of the asset is 10 years. Okay. Straight line depreciation 1000 divided by 10, 100 first year, second year 100. After 2 years, the carrying amount as on 31st March X3 is 800. Let's say at this particular point of time, after 2 years, we have indicator of impairment, external or internal as the case may be. Definitely, you need to check for impairment testing. Once you do that, you have calculated recoverable amount, which is only 640. Then definitely there is an impairment loss of 160, which will be taken to P&L account, which we already know, the treatment and everything. Okay. Now, the revised carrying amount from this particular date after impairment, where you have reduced the value of the asset by 160, is how much? 640 instead of 800. Now, hereafter on the 640 only you will put depreciation. Now, this 640 life is how much? Original life is 10 years. 2 years already finished. Therefore, the balance is 8 years. Now, 640 divided by 8. Now, the depreciation will be 80. But actually, if there is no impairment, the depreciation should have been 100. So, you would have debited 100. But now you are debiting only 80 instead of 100. That's why I put the difference as 20. Okay. Next year also again the depreciation is 80. If there is no impairment, depreciation would have been 100, which means again you have saved 20, which means you are debiting 20 less. Of course, here already you have debited that balance 160. Now, the carrying amount after 2 more years, which means here 2 years done, another 2 years done here, which means literally after 4 years your carrying amount is 480. Now, after 4 years, you had an indicator, external or internal as the case may be, of reversal of impairment loss. You had an indicator which says that asset value would have got increased. Therefore, there is an indication of reversal and you have calculated recoverable amount and it came around 750. Super, sir. 750 means what is the difference? 270. Let's increase the value of the asset from 480 to 750. Now the asset value will be 750. No. Then how much can I increase, sir? Very simple. If there is no impairment loss in first place, what would have been the value of the asset today? Calculate that. If there is no impairment loss in the first place, what would have been the value of the asset? What is there, sir? 1, 2, 3, 4 years. Na? 4 years means each year the depreciation is 100. 4 years means 400. The value of the asset would have been 600 only, na, sir? If there is no impairment, the value of the asset would have been 600. Okay. Now, what is the value of the asset? 480 carrying amount. Okay. Then maximum how much can I reverse? 120. That's all. If there is no impairment, what would have been the carrying amount of the asset? Because of impairment, what is the carrying amount of the asset? That is the maximum amount of reversal. Maximum amount of reversal. Ceiling limit. Okay. Because you can't do upward revaluation of the asset, na. It can't go beyond your carrying amount if there is no impairment. That is the logic, na. Okay. So 120 is the number that I've got, which means it cannot be beyond 120. Now, like this also you can calculate 120, or there's another way to calculate 120 as well. That other way only here I've put. Okay, here. Many people don't understand this other way. If you can see here, impairment loss is how much? 160. This much impairment loss like this directly can we add? Reversal of impairment loss is that only, na? Some students have told me this also, sir, it should match, na, sir. The reversal of impairment loss means what, sir? Whatever the impairment loss, that should be reversed. Sir, impairment loss is 160, sir. So simply come and add 160. So here the number should be 160. Now why it is 120? And that is why I've done this calculation to prove, which means here impairment loss is 160, which means this much you have debited. This is debit only, na? And because of that carrying amount has got reduced. Because of the depreciation per year has got reduced. Because of that this much you are debiting less, na? So this much you have debited here, this much you are debiting less. So therefore the net effect is not 160, it is 160 minus 20 debit less, minus 20 debit less. So the net debit is only 120. Therefore 120 only can be reversed. Are you able to understand? So this is another way of looking at things, because I've included this. Logical speaking, it is not necessary. Simply put, without impairment, the value would have been, carrying amount would have been 600 after 4 years. With impairment, it is 480. Therefore, the maximum reversal is 120. This is simple. There is no confusion. But some students have asked, already impairment loss is 160 na, sir. So if you reverse it, it has to be 160 na. But why it is 120? Because 160 you have debited here. Debit, consider that as a negative. But 20 you have saved, 20 you have saved here na. Therefore, that is positive. So the net debit is 120 in reality what you would have done. Because if there is no impairment loss, here the debit would have been 100. Here the debit would have been 100. Are you able to understand? So because of impairment loss, there is a benefit also na. So total impairment loss is negative, minus 160. But there is a benefit of 20 and 20 in the form of less debit. So plus 20 plus 20. The net effect is minus 120 only. Therefore, to the maximum extent I can reverse is 120. That is the logic. Hello, I hope we are done with this. Now suppose, see here. Maximum ceiling limit is 120. Suppose in this case, recoverable amount I gave it as 750. Instead of 750, let's say it is 550 only. Carrying amount as on today is 480. Recoverable amount is 550, which means maximum how much? I mean, here at least the difference is how much? 70. Actual reversal. Whereas maximum ceiling limit is 120, which means what you will be doing the reversal? 70 only. Here if you see the difference, the actual reversal is 270, but the ceiling limit is 120. Therefore, I went with 120. For this carrying amount, I've added 120. It became 600. You understand the point? Whereas if the recoverable amount is 550, actual reversal is only 70. Maximum is 120. Therefore, in that case, you will go with 70 only, whichever is less. Therefore, 480 plus 70. In this case, the revised carrying amount will be 550. Do you understand the point? This 120 is not minimum, Nana. It is maximum. The ceiling limit is 120. Here, if you look at the recoverable amount, it is 750, which means the difference is 270. So, entire 270 reversal will I do? No. You can't do upward revaluation of your asset. It's not possible. So, therefore, you calculate the ceiling limit and beyond this, it can't go. In this case, it is anyway not touching the ceiling limit. Na? Therefore, whichever is less. So, you'll go for 70 only, not 120. 120 is not minimum, Nana. It is maximum. 120 is not minimum. It is maximum. I hope this is clear. Clear? Right. Final, last one. Reversal of impairment loss for CGU. Right now, we have done it for individual asset. Now, what about CGU, sir? Here. On one column, I have got other assets for CGU A, laptop, camera, mic. Another column is goodwill. Okay. Cost 15 lakhs, life is 10 years. So, obviously, straight line method, 1,50,000 first year depreciation. And you have calculated carrying amount, 15,50,000 is the total carrying amount inclusive of goodwill of the CGU A. Recoverable amount is given. There is an indicator of impairment and the recoverable amount is given, which is 11,70,000. So, there is an impairment loss of 3,80,000. Now, what is the order in case of CGU, especially when there is goodwill? The entire impairment loss, first it will go to goodwill. Goodwill is how much? 2 lakhs. So, entire 2 lakhs will be reduced. How much is left over? 1,80,000. That 1,80,000 will go to other assets. Clear? Now, other assets is not given individually. Otherwise, in the ratio of carrying amount, it will go, or pro rata basis, it will go, which we have already learnt. Okay. 1,80,000. Then what is the revised carrying amount? 11,70,000. Already how many years are done? Out of 10 years, I think here this should be 9 years now. Not 7 years now, 9 years. Okay, 1 year is gone. 9 years is left out. So 11,70,000 divided by 9 years, you get 1,30,000. Okay. Then you have got carrying amount. This is second year ending, 10,40,000. Now you have another indicator of reversal, external or internal as the case may be. Now the recoverable amount is 15 lakhs. Okay. Now how much reversal should I do? How much reversal should I do? Very simple. If there is no impairment, what would have been the carrying amount as of today? If there is no impairment, same logic only. If there is no impairment means here 1,50,000. Next year also it would have been 1,50,000. So see here. If there is no impairment, 15 lakhs is the value of the asset, minus 1,50,000 minus 1,50,000. So the value of the asset should have been 12 lakhs. Whereas as of now, the value of the asset is how much? 10,40,000 because of impairment. So maximum reversal is 1,60,000. Here the value is going beyond that, na? 15 lakhs and 10,40,000, the near difference is almost like 4,60,000. But the maximum is 1,60,000. Therefore, increase the value of the asset by 1,60,000. Goodwill will not be reversed. Goodwill from 2 lakhs, it has become nil. And after that, again, it will not become 2 lakhs. Although there is a chance over here because the difference is 4,60,000. Correct? But goodwill will not be touched. With respect to this one, how much maximum reversal is nothing but if there is no impairment loss, how much would have been the value? That is the maximum reversal. That's why I went with maximum, which is 1,60,000. So the revised carrying amount will be 12 lakhs. Got the point? Goodwill will not be touched. So even though there is an actual reversal of 4,60,000, that is the difference between these two. Maximum that is allowed is only 1,60,000. Therefore, reversal permitted is 1,60,000. Reversal of impairment loss of goodwill not permitted, as it will lead to showing self-generated goodwill. That is nothing but internally generated goodwill, which is not allowed. So you cannot recognize that as per Ind AS 38. That is the point.